It's best to ignore sell-offs over the next several quarters, even one that might last a month. Well, that doesn't sound like a lot. So silver goes from 1.3 to 3. You think, well, big deal. No, it's a big deal. The upturn in silver miners has been more than GDX. So SIL has actually broken out versus GDX. So it tends to validate what we see when we measure silver versus gold. The silver miners are also beating the gold miners. I don't think you get a massive bear market again. I think what's about to happen globally, and we're seeing evidence of it here and there, and also among some major countries, I think we're going to a gold-backed currencies again. Everybody thinks gold responds to data points. We argue, no, it doesn't. It anticipates. It anticipates major trends before they occur. Silver is money, after all. Large parts of the world, it's treated as money. In fact, Alaska, I think some other states have done this too, just legalized as legal tender gold and silver.
All right, Michael, you and I spoke 3 months ago or something along those lines, and you told me that the momentum in gold was looking strong. You've turned out to be right so far, because gold has crossed. It was below 2,000 actually last time we spoke. It's crossed that 2,000. Quickly started making a push for allegedly the 2,500. Couldn't get there. And it slowed down after that to where it is now, sort of in a 2,300 to 2,400 range. What are the charts telling you? What's momentum showing you? What's happening with gold?
Well, this happens in the past and prior bull markets in gold, where you'll have a protracted bull market that if you stand back and look at it on a long-term chart, you'll see it goes for 8 or 10 years. You can look at gold in the mid-1970s was trading at $35 and went to 200. By 1975, and by 1980 it was 850. So really over a 10-year span, it went up huge. Then also from like 2001 to 2011, it went from like $250 to $1,920. But it took it a while. But in that last year of each of the bull trends, like in 1979 to 80, and like in 2010 to 2011, there was an acceleration. In other words, we didn't arm wrestle our way all the way to the end of the bull market. We blew a cork. And a lot of the tonal nature of the market prior to that acceleration phase teased a lot of analysts into thinking that's the norm. Well, just like, let's take the last 3 years, for example, in gold, where we shot up to 2,070 back in the summer of 2020 and took out the old high of 2011, which happened to be 1,920. So we took it out by 100 some odd dollars. And then we went into a 3.5-year range.
Mm-hmm.
With one stinger in gold back in October 2022, they dropped down to the 1,600 zone, but that was very, very brief. But basically in a 15% range in gold for 3.5 years. And so people that was the inhale, exhale process. People thought that's the norm. And sure enough, every time you get a rally, you could sell it and you get a sell-off. And it was smart to sell strength or to sell what people thought was overbought. Okay. Now, during that same time, of course, silver and the miners didn't go sideways. They drifted down in layers. So they vastly underperformed gold during that 3-year period. But anyway, it created a habit among technical analysts as to what's overbought. And so now they're trying to apply those same metrics to the current market. And I think they're going to get paved under. We've already broken most of those dynamics. In other words, what used to be overbought, let's say on an RSI chart or an MACD or any of the common metrics, we've blown them out. And it hasn't worked to sell them. Okay. Yeah, you do get the sharp sell-offs, but they don't seem to sustain. Like, what was it, back in April, we had like a very sharp $2-3 sell-off in silver, sharp sell-off in gold, and boom, back to the highs again. And so they're very brief. We're in an acceleration phase, is what I'm trying to say. And I think that what we're going to see over the next several quarters will be very dramatic.
Well, you're sometimes when you come on and I put something in the title among the lines of $8,000 gold or whatever, you catch a lot of flack for it. People are always like, "Oh, this guy's crazy. What is he talking about? We even listen to him? Why do we even talk to him?" But I mean, well, so far the things that you're telling me, they're turning out to be Right. And in that case, how do you feel? And this comes from one of your recent weekend write-ups. I believe it's a 360 degrees weekend write-up that you send on email, where you talked about dealing with those corrections that you're talking about here. And you were specifically talking about silver, but it's also making me think about gold. Sort of at what point is a correction actually breaking or leveling off the trend for gold? And at what point is a correction worth going out of?
Okay. Well, if we go back and look at those last two big bull markets, the one that peaked in 1980 and the one that peaked in 2011, and look at that last year where things went parabolic. And by the way, when I say parabolic, what happened in that last year also was that silver vastly outperformed gold. It was like 3-1. It beat gold, on a percentage basis. Whereas during the prior years of the bull trend, it was more of an arm wrestling match for silver to hold its own with gold. But then suddenly it just unleashed. And silver went like from, $15 to 50 or $20 to 50 in a matter of several quarters, 1979 to 80, 2000, late 2010 to early 2011. Silver's now broken out versus gold, which further validates our assumption we're entering an acceleration phase, because that's exactly what happened in 79. That's what happened in 2010. Late in the bull trend, silver engaged versus gold. So they both went up, but silver went up a lot more. Now, in both cases, you're talking about a correction. Okay. We've itemized and gone back and looked at the 79 to 80 tail end of that bull market and the 2010 to 11 tail end of that bull market. And especially looked at silver, but this is also true with gold. You'll find many starts of what looks like a correction under a trading range environment, but we're not in a trading range anymore. We're now in dynamic phase. It's a teaser top and it drops, and maybe you drop for 2 weeks, boom, new highs again. Okay, so if you blink, if you got out at each of those flinches and you didn't get back in, you missed it. You missed the most dynamic phase of the entire bull trend. There was one time in each of those tail end acceleration phases where silver did have and gold did have a correction that you could call a correction, something that lasted 1 month, not just 1 week, but 1 month. And we could identify that via momentum metrics, meaning price starts to drop again like its normal little quick sell-offs that it has in that acceleration phase. But this time, you're doing enough damage on some momentum metrics that says, oh, this is going to be actually a correction, meaning it might last a month. So now, what do you do about that? Because in each of those bull trends, well prior to the final blast, you had one of those type of corrections that you felt like, oh gosh, that was the top. And sure enough, for a month, you're under pressure and your sentiment's hurt and so forth. If you're an investor and you're not using leverage positions, let's say you're just long bullion or an ETF that's non-leveraged, or you're long mining stocks, again, no leverage, it's best to ignore sell-offs over the next several quarters, even one that might last a month. Because if you do get out, you may not get back in. Now, if you've got call options or you're highly leveraged in futures, let's say, then it is of concern. But right now, we do not see the technical merits to justify the onset of a real correction.
And that's true for gold and silver?
Yes.
Okay. Because one trend that seems to be breaking is kind of as what you mentioned, is sort of this multi-year upward trend in the gold to silver ratio, where it was below 60 about 3 years ago, and then it climbed back slowly but steadily to over 90, with this gold outperforming silver to the upside. And as you mentioned, silver is now breaking or has broken that ratio. What do you make of this, of the momentum within the ratio specifically?
Yeah, if you go back, we've run this spread many times. We don't do it the way everybody else does with a ratio. We simply divide the price of silver into gold, express it as a percent. So, if you go back over the last 50 years, there's one time silver was 6.5% of the price of gold. That was a rarity. Forget that. But in the last 50 years, if you identify the peak reading of silver in relation to gold, silver ounce per gold, you'll find that there were 20 times in that 50-year period where silver reached at least 2% of the price of gold. But right now we're above 1.3% of the price of gold. So it's almost a norm to at least get up to 2% of the price of gold. It's not a rarity at all. It doesn't even depend on a bull market. And there are plenty of times in that last 50 years where you also got up to 2.5 to 3% the price of gold. Well, that doesn't sound like a lot. So silver goes from 1.3 to 3. You think, well, big deal. No, it's a big deal. Because when you do the math on it, well, like let's say gold went to, you threw out the 8,000 number, and that's a number I've thrown out before, not that I'm projecting it. It could go a lot higher than that. But if you go back and look at the prior bull trends of the last 50 years, they were eightfolds, at least. And if we have an eightfold move, we started from 1,050 bear low in 2015. Eightfolds, $8,000. So that's merely doing what you've done twice before in the last 50 years. And if you go to 2% of $8,000, okay, you do the math. It was $160 gold, silver, it's a huge move. So watch that spread, and the spread is broken out, silver relative to gold. And it's been in a downtrend since 2020, when we had that surge in the summer. Since then, silver's underperformed gold. So have the gold miners, and they've also broken out relative to gold, which is another good sign that we're in the acceleration phase.
So momentum and everything else, because this is the ratio specifically, but does momentum and all the other charts and everything that you look at, does that confirm that silver has more potential than gold here?
Yes. Yeah, the spread and the momentum of the spread both argue that, yes, silver has underperformed since 2020. Now, remember back in the summer of 2020, from the spring to the summer, silver vastly outperformed gold. Had you bought silver in February, March, April of 2020 and sold it in August of 2020, you'd made a lot more in silver. But then it started to underperform for the next 3.5 years. That's changed. That technical dynamic has now shifted the other way, and so have gold miners versus gold. They've underperformed. They've also broken out. So going forward, I would say if you watch gold, it's the mama market, but you should emphasize owning miners and silver.
Well, then that's the other ratio that I wanted to talk about. That looks like it wants to be broken at this point. It's not yet broken based on what you've written. And that is the gold to equities ratio, and specifically mining equities, as you mentioned, where again, the metal has outperformed over recent years pretty decently too. And so that trend doesn't look broken yet, but it seems like it's on the cusp of being broken.
You're talking about the miners versus gold or the stock market? Oh, the miners. No, they've broken out. They broke out in April, a month ago. The spread I'm talking about. So did the net price and the net momentum of the miners, but also their ratio to gold. While, oh no, we're not back to for instance, the 2020 highs. Back then, GDX was $45. Right now, it's what, 37, 36? Okay, 35. So it's still got $10 to go just to get back to those highs. So when you look at it that way, you say, oh, they're still underperforming. No, they're not. Because since the February low in gold, silver, and the miners have gone up a lot more than gold on a percentage basis. And in the process, technically speaking, that spread has broken out, refavoring the miners again over gold. And I think that's also what happened like in 1979 in the acceleration phase. The miners, that was the place to be, that and silver. So I think all the metrics are telling us, no, we've entered the acceleration phase, and this time, while gold's still the mama market, the others are going to beat it.
What's the timeline, or how long does that dynamic typically go on for, where we shift, we shifted from the metal outperforming to now?
Several quarters. It's that fast. Really is. You go back to 79 to 80, and you can measure it within 3 quarters. Same with silver, for example, started to accelerate in price and momentum of price in late summer 2010. And silver made its $50 high in April of 2011. So, you're talking less than a full year. So several quarters, I would ballpark it, which is to say a lot of what I think is going to happen is likely to happen before the election.
And then what do you do? Do you trade it or Because you
No,
said, I mean,
I
so
don't think this time we peak gold. In other words, I don't think you get a massive bear market again. I think what's about to happen globally, and we're seeing evidence of it here and there, and also among some major countries. I think we're going to a gold-backed currencies again. There will be a shift toward that. China's already doing it. Russia, uh, let's see, a couple countries in Africa have done it recently. Zimbabwe is one of them. Ghana, I think, is another, that are shifting out of their highly inflated fiat currencies and saying, hey, we just need a stable currency. And they're going to gold-backed currencies. And frankly, we're not an exception to that. I mean, our currency is hardly good in the sense that the quantity of our money doubles every decade. M2, it doubles every decade. So it deteriorates that much is what it says. Because, when I was a kid, loaf of bread cost, 20 cents. Now it's $3.80. So we have a wheat crisis? No, you have a constantly deteriorating value of the money unit. And pretty much you can look at an M2 chart, go back to the late 50s, and you'll see that it almost doesn't matter whether there's a recession in that decade or not. The money supply just doubles.
But now you're adding fundamentals to the mix. I thought we weren't supposed to do that. I thought you only did momentum analysis.
Yeah. Well, I do, and I try to ignore. I have certain fundamental macro views. Okay, philosophically speaking, I'm a libertarian. I've written a book on it and so forth. But I exempt that from my analysis because there are times I've been bearish on gold. The MSA was bearish on gold in late 2011, especially January 2012. That was 3 months off its high at 1920. We got bearish gold, and sure enough, as soon as we got bearish, gold went into a trading range. It didn't collapse. And we'd got bearish right in the middle of that range in like mid 1600s. And it dropped to the mid 1500s, back up to the high 1700s, and just stayed there for a year. And finally, it crashed in 2013. And we had to admonish our subscribers and explain to them why we're bearish on gold. It was technical. It's not that we thought gold was no good anymore. We just thought technically it was going to have a bear market. And it took it a while. A lot of bear markets take a while after you're topping. You don't just top like that. You labor. Stock market's doing that right now, for example. And I think gold this time, though, there's going to be a difference because this is not just a gold market. A lot of those moves in gold were coincident with certain other markets. There have been times when the gold goes up and the S&P is going up too. Okay, they're not necessarily out of sync. But right now, we argue this technical case, and it makes sense fundamentally. The major bubble in the U.S. stock market is topping. It's been topping since 2022. You look at various components of the market to come up with that conclusion, but that's our conclusion. The new teasing highs in the S&P and NASDAQ don't fool us at all. The bond market is in trouble, the T-bond market. Now, when you get the U.S. government bond market in trouble, what does that do to the central bank? They may not want to talk about it, but that's a major issue for them. We're no longer talking about Lehman Brothers in trouble. We're talking about U.S. government debt in trouble. And if you compare a bond market, T-bond, U.S. government T-bonds, look at a chart of it, and then look at, let's say, muni bonds or high yield corporate debt, HYG, for example, ETF. Compare the charts, and you'll see the one that's under the most pressure right now is U.S. government debt, not private debt, which is a real table changer. And there's no doubt that that's going to concern the Fed, even though they won't speak about it, because that's the one thing they have to do is defend government debt.
I have a very
that means monetary policy. That's what it means.
I have a very sort of 70 IQ approach to it myself, and that's that the bonds only go down, have only been going down recently, even though I keep seeing bullish theses on bonds. But there's really what it appears to there to be a lack of is buyers. And there's a very fair question that I haven't gotten a good answer on within bonds is who's going to buy all these bonds? They're gonna have to be issued. That's what what do you think?
Well, what I think is this. I think the bond market is about to make a low, actually. Now, whether we take out last October's low, we made a low in October 22, it was crash-like, then had a rebound. Made a low in October 2023, last year, and had a rebound from, well, take TLT, for example. It's a popular ETF of long-dated U.S. government debt. It was down to like 82, 83, and went to 100. where you're back down around 90 something. So it's either going to try to take out that low or not, but it has sufficient momentum structure set up so that I could see this situation unfold. T-bonds choking a lot of asset categories right now because high yields. Okay. Let's say commercial real estate, for example, which we're watching very closely and looks very vulnerable for another major drop. But what would cause bonds to rally? In 2022, when we had the big down in the stock market, S&P down 20 something, NASDAQ down 30 something, bonds were down 35%. So it didn't work. They weren't an alternative. They're technically set up now where they could be an alternative again, where there's a point at which, and I think it could be pivotal, and it could happen anytime soon, and I suspect it's going to unfold in the next month or so, where T-bonds start to turn back up and S&P turns down. And they're opposites. They're out of sync again. And at that point, not only will gold be advancing, but T-bonds will as well, meaning yields drop. This is what happened, by the way, in 2007 and also in 2000 when the stock market was peaking, the dot-com peak, 2000, 2001, or 2007 when it was peaking the real estate bubble. At that point, when the stock market peaked and started down, T-bonds went up, meaning yields dropped, and gold went up. They were hand in hand. Lately, you've seen bonds under pressure while gold has gone up. So they've not been hand in hand, but we could see that flip pretty quickly. And what it would indicate to us is there's enough asset managers out there who perceive that, one, bonds are probably oversold despite the negatives we can talk about. They're oversold. If they start to behave technically well, that will attract their attention. And they'll again view it as an alternative to the stock market, which is, the traditional portfolio, 60-40, right? 60% stock, 40% bonds. That didn't work in 2022, but it might work again this year at some point. And we've got certain defined levels above the bond market and TLT that will tell us they're breaking out. And when they do, I think it could be a gusher. Now, I don't think it's a multi-year thing. I think it's a multi-quarter event, but it could be very strong and it could be coincident with gold. Anyway, it's something to watch. So yeah, I agree with you on those. Who's going to buy bonds, right? Especially US bonds. Well, there's a point at which that argument makes some sense, but then suddenly you get in a technical point where it's maybe overdone for a while,
Yeah. I had the same thoughts for natural gas, but the natural gas just remained overdone for like, what, 2 years now?
Yeah.
So that's why I also like, mingling with the fundamentals too. What would the fundamental reason be though to get a kickoff in bond buying when there's like, I kind of see bond buying as demand for yield and gold buying as demand for safety. But if there's demand for safety, what is that safety from? Is it not from the government messing some stuff up? So why would you then demand yield from the government? That's kind of along the lines of what I'm thinking. I don't know if I'm making any sense.
Yeah. I think it's a matter of technical excess, really, because when we analyze T-bonds from an annual momentum perspective, now what I've been talking about with TLT and bonds about an upside breakout, a drop in yields, rise in price, is based on fairly long-term metric, but not that long-term. We're basing it on quarterly momentum, 40-week average structures that we see on momentum. You don't see them on price, you see them on momentum. You have to go to our reports to see that. But it's very clear that there's a potential breakout there. But when you go to annual momentum, and this is the big issue about, is it really lasting? Okay. You look at annual momentum of T-bonds, and it says, so if you get a big rally now and a drop in yields, don't count it lasting more than several quarters, because it's a counter trend rally in bonds, meaning their major trend is down, higher yields, but they could be due for a counter trend rally that turns some heads. So that's what we're talking about. I'm not talking about some long-term investment buy opportunity. I'm talking about something that could last maybe just several quarters, where some panicked money moves out of what they perceive to be a high-risk, low-reward arena, stock market, let's say. It starts to get wobbly. People say, okay, there's enough skeptics out there after all. Some very large fund managers who've already expressed skepticism about the stock market, yet have to be long because they're competing with other asset managers. And if you're not long and you're missing out on the up move, you lose client base. So while they may be long, they're skeptical. And if you give them a little poke, You drop the S&P 5% off its high or something, you're going to get some nervous money wanting to move into that other often alternative category, which could give you this counter trend rally in the T-bond market. And that's the way I would predefine it. It's not a major investment move, but it could be a sharp counter trend rally, a drop in yields, not sustainable.
But so basically ignore it at this point is what you said is the best. I mean, if you're already long gold, just ignore the move in bonds. Is that how you typically go about it?
No, well, I think that the bonds could sort of reinforce gold. Everybody thinks gold responds to data points. We argue, no, it doesn't. It anticipates. It anticipates major trends before they occur. And I think what gold knows and is known for the last several years, and there have been people that now point out that, hey, gold over the last 5 years beating the stock market, and it's certainly beating it the last year or so. And a few people are pounding the table about that, but it's a fact. Why is that? Why is gold doing so well if the Fed is, quote, fighting inflation with tight money? Well, remember, Fed fought inflation all during the 1979-80 bull trend too. Raised rates like crazy and gold exploded. So gold anticipates that probably in this case that one, we have a stock market bubble. And when it breaks, it could be the biggest bubble breakage in US stock market history. How do we define it as a bubble? It's 4 or 5 times more upside in percent than any prior bull market in US history. And it's 3 times as long in duration, 23 to 29, to 1970, the dot-com peak in 2000 was like a 5-year bull market. The 2007 peak was from a 2002 low. So all these lasted about 4 or 5 years, and they involved doubling, tripling, maybe quadrupling of the stock market. But here we have a situation where the S&P has gone up 8-fold and NASDAQ's gone up 17, 18-fold since 2009. So there's no comparison. If that's a bubble, and we argue it is, caused by what? Look at an M2 chart, you'll see part of the reason, money supply expansion. But 2, look at a Fed funds rate chart. And you'll see that prior to each of those bull markets, like prior to the dot-com, they cut rates to a 30-year low and kept them there for a couple of years. Dot-com bubble followed. Same thing happened between 2002 and 2001 and 2004. They cut rates to like more than a 30-year low historically. And you had the real estate bubble and the stock market. And then starting in 2009 through the present, except for a 2-year exception, the last 2 years, they had rates effectively at 0. So it sort of explains why you have a stock market bubble. Money was free, So if money's free, you put it somewhere. The only problem is they priced that asset category off the page. So maybe they want to shift it. You know what I mean? And so when that bubble breaks, usually you get pain, data point pain, kind of stuff the Fed says, gee, we don't see enough weakness out there. Well, you break that stock market, and I almost guarantee you within the next month, 2 and 3, you're going to start to get very negative data points on the other mandate of the Fed, that being the employment issue. They got the inflation issue and the unemployment. They're contrary. And they could very easily have a situation whereas the Bloomberg Commodity Index, which is now broken out in our view and reasserts itself again, meaning more commodity inflation. At the same time, you could get weakness in the stock market and therefore bad data points on the unemployment side. So here's the Fed with 2 mandates that are contrary. I almost guarantee they'll go for the employment. Okay.
Well, historically, it's also what they've done. There's sort of this belief that the Fed has very, very many and complicated tools for dealing with all sorts of issues. But again, approaching it sort of from my 70 IQ perspective, they have one tool. We print more money. The bubble bursts.
Yeah,
we just pour more money into the system. Because is there really another option?
No, that's it. I mean, that and the ECB and the BOJ will all be in unison. They've been slightly out of sync with each other lately, but even the ECB is hinting we need to cut rates soon. And there's enough Fed governors talking about, we think inflation's coming down, but we need a little more, but it's coming down. And of course, what they're looking at for inflation is not pure commodity price inflation. There's CPI and PPI. That's a factor, but it's not the total thing. But the commodity asset category has just restarted a new up leg. after a 2-year correction from the 2022 highs in the Bloomberg. And in most commodities, oil peaked, pulled back, grains peaked, pulled back, et cetera. They're reasserting themselves. And we technically argue that Bloomberg is now going back up. This time it's in sync with gold. It wasn't in sync in 2022. Gold had already peaked in the summer of 2020, and commodities were still at their lows. And as gold went into its range, commodities exploded. But right now we're back in sync again, where the Bloomberg is starting to move with gold. Now that's a nuisance for the Fed, but on the other hand, government debt market and employment issue is a major issue for them. And you can bet that there'll be sufficient pressure that they break. That's what gold knows was coming.
The Bloomberg index is mostly oil, though, so it potentially has...
No, it's well balanced. Now, some of the others, you're right, some of the commodity indexes are heavily weighted in energy, but Bloomberg is more balanced. Energy sector is not so heavily weighted there as it is in some of the others. I think Goldman Sachs has one which it's more energy weighted. Bloomberg is a little more balanced.
Yeah, the GSCI is mostly oil. That's what I'm thinking. Yeah, mostly energy.
That's quite true. Yes.
Yeah. And I suppose that's a little bit tipped off due to geopolitical tensions, and maybe that's messing up with the chart analysis.
I don't know. That argument, though, the Fed came up with that and the government came up with that the war in Ukraine and Russia war, it started late February 2022. Okay. It surprised a lot of people when it happened. It was a debate whether it was going to happen or not. What had happened in the 2 years, in the year and a half prior to that, commodities broke out upside in October of 2020 by our metrics. So we put out a report said commodity explosion. Sure enough, from October 2020, at that point, the Bloomberg Commodity Index was around 70 in price. It shot up to 140 by March of 2022. In other words, it peaked 1 month after the onset of that war. So did crude. So the argument that war tightened the wheat market, tightened the oil market, et cetera, doesn't make a lot of sense, because 95% of the entire advance had occurred prior to the onset of that war. And then once the war started, oil collapsed from 130, 40 down to into the 90s, 80s, et cetera. And so did sort of the grains and a lot of commodities. So it wasn't correlated to that event, even though they like to point to that and say that was the reason. It wasn't because us printing money. Okay. Well, anyway, gold knows better. And I think that's what gold is doing. Gold is a smart market, and it sees these macro fundamentals. And like I said, if the stock market's topping, that's going to cause the data points to shift. And I think gold knows that. And it's not going to wait for all of a sudden the Fed to panic again. By the time the Fed panics, gold will be halfway to where it's going.
And by design, then silver too.
Yes.
Does it not matter that silver has that dual demand profile, though, where it's an industrial metal as well as a monetary metal?
Yeah, well, it's an essential metal in the industrial sector, but it goes berserk in those last two bull markets, for example. It goes berserk in the last several quarters. And it's not because of a sudden shift in industrial demand. You don't take $15 silver to 50 in 3 quarters, or $8 silver to 50. It doesn't happen because of that factor. It happens because of desire to buy monetary metals. And silver is what? The poor man's gold. And already we're seeing, for example, in India, massive quantities of buying of silver. Something's going on there. Silver is money, after all. Large parts of the world, it's treated as money. In fact, Alaska, I think some other states have done this too, just legalized as legal tender gold and silver. In other words, it's not just the dollar, but gold or silver can be treated as legal tender. A lot of states are also abolishing any taxes on gold or silver, treating them as money, in other words, not as a commodity. These are, in effect, secessionist efforts. They're telling the Fed, hey, you don't control money anymore. We're acknowledging gold and silver. Interesting step. But no, I don't think the industrial factor will be the key factor there. For silver.
We just talked about equities, and you said that gold equities, so the miners are now starting to outperform the metal. But if you think that silver's got more torque to it, then
Yep.
silver stocks over gold stocks.
Yep.
Does that make sense?
We've run a spread on that as well. In the latest weekend report, we measured SIL ETF, silver ETF miners versus GDX. And while the gold and silver miners underperformed gold from the 2020 highs through recent lows, the upturn in silver miners has been more than GDX. So SIL has actually broken out versus GDX. So it tends to validate what we see when we measure silver versus gold. The silver miners are also beating the gold miners. So I think that's, if you're going to be in the miners and you want to narrowly focus, then focus on some key silver miners or SIL.
So in terms of potential here ranked, because that's kind of what I'm noting down. You're seeing silver stocks, then gold stocks, then silver, then gold. Is that how you would rank them as having the most upside potential?
Yeah, I would. What I'm doing personally, and we don't advise people on portfolios. We're not money managers or anything of that sort. We just put out a market letter. We time markets. But what I'm doing personally, and of course everybody's different. Some people use leverage, some don't. I'm focused on SLV calls, silver bullion ETF calls, out late this year, early next, near the money. And I'm focused on GDX. And GDX does contain a handful of silver miners, some major ones. So it's not just a gold mining ETF. It actually contains silver miners. Now, if you're smart enough and want to analyze specific miners, you can. But I want to go for the option category, and therefore GDX has liquid options. And so again, I'm buying at the money calls out late in the year or early next year. And that's my focus.
But that's exactly what I was going to ask you, because in that weekend newsletter that you send out, you disclose your positions in it, and so you disclose that you're long basically physical silver and these other stuff, but no specific names, even though you did mention a couple of specific names that you looked at the charts of a couple of silver stocks. But I mean, if you think that silver stocks are going to outperform, why not, get exposure for more torque to one of these specific silver stocks?
Because I'm looking at call options, that's why, and I'm looking for liquidity. And a lot of the specific miners don't have the liquidity in their call options that GDX has, for example. So liquidity is a major issue for me. Yes, I realize that I might do a little better with silver miners. Now, I do own a few what you call junior miners and so forth that we don't quite often cover. I think you could pretty much throw a dart at that arena of the minor miners, okay, the silver, because a lot of them are just going to get bought up. And so they might be 50 cents now, and in 6 months it might be $8, that kind of thing. And we don't try to analyze them fundamentally. We look at things every month. We run performance analysis of miners within the GDX, for example, and measure them versus GDX in terms of their relative performance. And it's always the case. And no matter what stock sector you're looking at, you'll find some stock sectors members that are outperforming the sector, some stocks within the sector that are underperforming. It's not always the case that the outperformers continue to outperform for the whole trend either. You might halfway through the bull trend, what's been an outperformer would be replaced by an underperformer. So it's a constant process. And to that extent, if you do that, you could probably beat GDX. But that's frankly not my concern right now. My concern is the liquidity of call options. And that's why I'm focused on that. Okay.
And is there anything else besides gold and silver? Because we mostly focus this whole thing on precious metals, but it also seems, because you have this portfolio grid that you send out as well, and I can see negative. Emerging markets you're positive on. Are you more positive on emerging markets than precious metals?
Or less? No. Emerging markets move like the S&P, but they're not bloated. Whereas right now, for instance, EEM, emerging market ETF, which is about 26% Chinese stocks, is only double its price versus the 2009 low. And it's frankly trading in a price range. EM is right now in the middle of the last 14-year range. It doesn't even look like the S&P, but its inhale and exhales, when you get multiple up months, multiple down, tend to reflect the S&P. So lately, well, the S&P went up and nipped out the high, and NASDAQ did by 5-10%. EEM didn't, but it did go up with them. And now it looks like it's starting to roll over from resistance, just like I think the S&P and the NASDAQ will. So if the stock market in the US goes down, expect other stock markets to go down as well, including EEM. But it's not a bloated bubble. It's not a crash event. It's not committed a sin. It hasn't been inflated by, a central bank as the US has. So it does move in sync, but it will go down with the market, but it will not go down as much. So there's actually a spread possibility there. You could buy emerging markets and sell an equal amount of, let's say, S&P at a certain point where you can make a lot of money on a global neutral spread. Long the emerging, short the US, equal balanced, so neutral position. And yet the US is going to go down a lot more than will emerging markets on a percentage basis.
But why even bother at this point?
Yeah.
I mean, if you're that bullish on gold and you have exposure to the miners or whatever, why even bother with these things?
Well, because our subscribers want to have a full view of the world. And I think that it's important to watch the stock market in particular now because it's to some extent a laggard component. We think it topped in 2022, meaning its annual momentum peaked and broke structure. So if you looked at an annual momentum chart of the NASDAQ 100, for example, you would see a totally different picture than when you look at the price chart, which looks very sexy. It's an upward curving arc type thing. And we recently took out the 2021 highs by enough to get people's attention. That due to about 5 stocks, as we all know. But when you look at its annual momentum, if you looked at that as a price chart, you'd say, I'm going to short this thing because it's up under violated structure, trend structure, whereas price isn't. Annual momentum tells us it's no good. When you roll that beast over, that's when you provoke the central bank. And what does that do to gold? It further accelerates what gold already knew was coming. So breaking of the stock market bubble will enhance the speed of the dynamics of quite a few markets. It could indeed spark, for example, the T-bond rally for the reasons we discussed. So it's one of the asset categories out there that while, if you want to be short stock market, fine, but you're not going to make the kind of money on a percentage basis that you will likely make in the monetary metals. So to some extent, being long gold and silver is in effect also betting on a downward stock market.
Well, and you have the Bloomberg Commodity Index. You have it as long-term positive, intermediate term positive, and trend notes, all trends positive. So it's all positive.
But its dynamics don't look at the same as gold and silver. This is true back in the stagflation era, 79 and 80. That's when commodities also went up with gold. They were lagged. Gold bottomed in 1976, and it wasn't until 1977 that the Bloomberg or CRB index then started to turn up. And even during the dynamic bull trend that they both had, they didn't beat gold on a percentage basis. So yeah, I think it's reflective of gold, but I don't think it's a better place to be than gold in the monetary metals.
Does that count for copper too? Like you think it's a good place to be, but still not better than the monetary metals?
No, still not better than the monetary metals. Now, copper's very interesting, and it's just a point to think about here. We know silver can go berserk late in bull trends. Think about this. Copper made a high in 2011 at $4.62. Okay. Then it dropped back. That's the same time gold peaked in 1920. They both dropped back. In 2020 summer, gold made a new high at 2070. Copper was advancing. Copper made a peak in 2022 at 502. Higher high than it did in 2011, just like gold did, right? Okay. It pulled back also from 2022 high in copper. And recently it went up and took out that high. Now it's back below it right now, but it took out that high. Same as gold. But look at silver. If silver were matching copper, a base metal, and gold, silver could be over $50 right now, just to play catch up. And it wouldn't shock me that if it is this year, it wouldn't shock me. So, when you look at historical and you say, well, gee, that's very undervalued, silver is relative to copper, relative to gold. And yet its dynamics indicate it's going to accelerate now. It wouldn't be a bad bet to assume that maybe it's going to take out those highs as well. Why not? Copper has, gold has.
And then long term, Because when you stack it that way, that's kind of interesting to look
Yeah.
at it. But long term, still positive on copper.
Oh, yeah. Long terms look positive. There's a number above us that we didn't quite get to. I think it's around 518 was the number we put out. And if you get up there, you're likely to accelerate copper as well. I think it could easily go to 7 at that point. In other words, you need to go back up and take out the high we just made and close a month up there. And if you do that, I wouldn't be shocked to see it go up to 7, which would be our next target. But again, percentage-wise, that's not going to compare to silver or gold. We don't think. It's going to be strong and yet noticeable. We know we have supply problems. That's been fundamentalists have argued that for the past year or so, that copper's got real supply constraints and that they're going to impact. Well, it didn't happen. Now suddenly it's starting to happen, where price is reflecting the reality that they explained. Okay, and that could be a factor in the overall Bloomberg as well. It could be among the leaders. Last time around, it was energy. October 2020 to early 2022, energy was tended to be a percentage leader as a component of the Bloomberg. This time around, I'm betting it's going to be grains and copper. And energy will follow, but I don't think it's going to be the percent leader this time. Let's see.
But how do you reconcile copper going up with your sort of grim outlook, if you will, on the stock market?
Yeah.
They say, you know, Dr.
Yeah.
Copper, PhD, this,
Yeah.
that.
Yeah. If you believe that, okay. I don't buy that argument. I know it makes sense. You know, copper demand means the economy's strong and all this stuff. We have a supply problem with copper. Some of it's politically related. You know, where governments have clamped down on, you know, taking over some mines, etc., whatever. But the point is, it's not matching the current demand, and to some extent, the demand is constant. You know, it's not necessarily economically dependent so much because it's an absolute necessity in so many components of things we use every day. Anyway, and so is silver as well. But I don't think that's really a factor. And I don't buy the argument that it's the economy. Sometimes it reflects it, sometimes it doesn't.
Fair enough. I don't have long enough of a track record to speak against that or not. You know what you mentioned earlier has actually made me think, and I know that you almost have to go here, so I know I'm jumping topic, but I wanted to talk to you about that. And I know you have kids, or you have a son, I'm sure of that's kind of my age. And you probably think about these things, right, philosophically, like what fixes this? Let's forget the charts for a second. Like what fixes this debt problem, these big issues that we have? What kind of a world is your son gonna live in?
It's going to happen quickly. Again, I will get off the subject of the markets. My background is I'm a libertarian. I wrote a book when I was a young man, master's thesis called Anarcho-Capitalism. That term had only been used by another guy I knew personally, Murray Rothbard, who was the founder of the modern libertarian movement. He died in the 1990s, but I knew him in early 1970s. And at that time, I wrote my thesis, and he said, this is the first one on this subject, you know, and he'd used the term anarcho-capitalism as well. What that is it's a radical statement of libertarianism. It means ultimately devolve away from status controls on your life. No, not suddenly, not dramatically, but sometimes if that's a true statement, it means your assessment is that status controls, meaning monopoly from above, legal use of force to cause you to do this, not do that, et cetera, way beyond the issue of policing and keeping order, but in controlling your life in so many different ways, like controlling your money. You know, how much money is there, what the price is. It's like if the government took over corn and said, we're going to determine the quantity and the price. Well, that's not a free market. That's what the Soviet Union did, or China did, you know, 40 years ago. But we control our money like it's an essential commodity. Well, that's an intervention in your life. It decays the value of your money. Every 10 years, your money's cut in half in terms of its buying power, meaning you've had inflation. So it affects your life. Ultimately, if that's an error, it will cause errors committed by individuals, families, corporations, investment decisions. Let's expand our house, build a new one, dear, et cetera, et cetera. Company, let's expand our factory, hire new workers. And suddenly you found that, oh, I made a decision based on free money. Suddenly it's not free anymore. And all of a sudden you're caught in an interest rate trap. You have to pay the debt off. So the error is exposed. Well, if that sort of system has reached its peak in terms of its dysfunctionality, not just in monetary issues, but others, then you'll start to see real world consequences. You'll see personal pain. Remember 2008 and 9, there was personal pain on the street when we had that collapse of that stock market bubble. This time it could be worse. And people don't know what it's causing it. They just know something irritates them. They're nervous, they're scared. And especially if you break that stock market, start to get the data points, that's going to scare people even more. Well, what's the political alternative to that? Well, maybe it's not the norms. In Europe, we're finding a lot of political parties that aren't the norms of the past 40, 50 years are suddenly arising in surprise ways in elections. In Argentina, it's a good example. Argentina used to be the 8th biggest economy on the planet about 60 years ago. Now, of course, it's not. It's been controlled by 2 political parties over the decades, both in a socialist direction. The last election last year, Javier Milei got elected. Who's he? He's an anarcho-capitalist economist. He's an intellectual, but he looks like a rock and roll star. If you've seen his picture, go online. The youth vote put him in office big time. He destroyed both parties in terms of the vote count. And he didn't even have a political party. He's now president, and he's starting to dismantle government. He's selling off whole portions of it. So, for example, in the sector that hurt people the most, which was the cost of rentals, homes, apartments, so forth, the government had controlled that market arena with all kinds of regulations, which ultimately had the effect of causing prices to remain too high and supply to be tight. His dismantling of that part of the government, the control over properties like that, suddenly the prices have come down 20%. So the average guy on the street who couldn't afford an apartment, now suddenly it's the horizon. So drastic, surprising things can happen. In this case, it was peaceful, but some of the parties down there actually tried to make it unpeaceful against him. So I hope he's got good bodyguards. He's a good man, okay? But anyway, things like that could happen. So that's partly why I think this election is different than any other. I think it's not so much because of the candidates. It's because certain macro issues are starting to pinch people and pinch them more. Despite the stock market seeming to say everything's great, the average guy knows it's not for various reasons. And if it gets worse, and we have the overt things like a stock market dropping and data points changing, then it creates a sense of we need something else. And that's why the vote occurred the way it did in Argentina. Totally shocked the world. Javier Milei. And I think it's not an isolated event. I think to some extent, Trump, I have my differences with him. He's definitely not a libertarian, but he is sort of an agent of history who happened to be there at the right time. Not that he created his situation, but he happened to be there at the right time where all these events are starting to collide. And he happens to be the one that says, no, let's reduce government. So it's possible if we have a debt crisis, which we're having now, we know that, and that yields are somewhat out of control. This Fed didn't cause long bond rates to go up. They control short end. That long bond market's on its own. And even Yellen has said she's very concerned about the illiquidity in the bond market. Okay, so it's somewhat out of control. Those factors can cause change and not necessarily change in the normal way. And I think to some extent, the election coming up is a reflection of something not normal. We've argued the outcome of the election will not be copacetic for either side. I don't care if Biden wins or Trump wins. You flip a coin, the outcome's going to be equally uncopacetic in terms of what's going on in the streets, turmoil, uncertainty. And that's a factor that's not factored into the stock market right now.
But it also seems like you guys have to choose between the lesser evil here. Like there is no libertarian candidate. I mean, I
No,
suppose there is technically, but like there's no real
more
chance.
so than others. Yeah, Trump is more so because I think he's the kind of guy, and especially some people around him. Like, for instance, I have a very high opinion of Vivek Ramaswamy. You know, he's got some more libertarian type views. I suspect that's why when Trump spoke to the LP, and I'm not a real friend of the LP anyway. It's not really pure libertarian, but anyway, Vivek was the introducing speaker, and I think Trump knew that was the guy to put up in front of the crowd there. And anyway, forgetting that issue, it's not so much who it is as the factors that are in play here. And it just so happens that at the same time, we have unusual candidates on both sides in terms of what's likely to happen. And it will not so much reflect that Trump is better than Biden, which I suspect he is on major issues. But he could be the guy, because people behind him in Congress especially, who could reform the debt market, who could drastically cut government spending, for example. So that the trajectory we're on now, which has been ongoing regardless of what administration's in power, including Trump, the rising government debt to GDP ratio, for example, that could suddenly change because there's enough people out there who realize we've got to stop the spending, and therefore that's the solution, not spending more, et cetera, et cetera. We'll see. Fortunately, I'm not involved. I'm sort of sitting up here looking down at it and say, yeah, it's a very interesting thing going on, and either way, it's going to be noisy.
Well, that is a take. It is grim, and that seems to be reality. Michael, I always appreciate our conversation. I enjoy conversations always, but I particularly enjoy hearing your thoughts on sort of non-chart matters, if you will. So maybe we should do a podcast only on these things, just to see how you think. I appreciate hearing different views. So yeah, thank you so much for doing this. It is olivermsa.com for people watching who are interested in Michael's more in-depth write-ups and stuff like that. He offers a service on there as well. We're not affiliated. I'm not getting paid to say that in any way, but just what it is. Michael, I'll let you drop off now as I'll be moving to the CEO barbecue part of today's Real Money Talks. But first things first, as always, there's a warning on your screen right now, people watching and listening. I am going to need you to pause the screen and read it. This is serious. It's not just some disclaimer that you typically get. Well, it is a disclaimer, but it is also an actual warning that I like sending out. First things first, I am here to make money. This channel exists to make money, but it's also no secret that at Read that we try our best to be different. And what different means for us is not hating the viewer. What that means more specifically is that I would like you to be aware of the fact that one of the company that you're going to see on here or hear from on here, with that being specifically FDR, so Founders Metals, you're going to hear about it later on in the conversation. They have paid for the production of this interview. The other company that you're going to hear from, they have not paid for the production of this interview. Regardless, though, both of these interviews should be considered advertising because these companies likely see their participation in the conversation with me as a chance to do a little bit of marketing. Okay, so start understanding that this should be, just be aware of the fact that this and other interview channels who interview CEOs or talk about companies or publicly listed equities, typically we earn our money by charging for the creation, publication of that content. My case, those are interviews. In my case, I'm vocal about it. I let you know. Doesn't always happen. That's why I say I try to be different by not hating the viewer, because people are not letting you know, I assume they hate you and they want you to lose your money. So although I don't make buy or sell recommendations because I think there is a conflict of interest, many will do. And so you should be aware of that fact and protect yourself. It's your money, it's your responsibility. And anytime you're watching any type of company specific content, just approach it with a dose of skepticism and use your brain. I like saying that. I don't always do it. It's not always easy. I know, but try. Right, I do. I try to do a decent amount of research as well. I don't give the companies the questions up front. Doesn't matter if they pay me or they don't pay me. No questions are off the table. No questions up front. No editing rights for the companies. That's my main three rules. still, these things, even given that that's a fact, these things should still be looked at as advertisements and not as research. This is not research, and least of all, it's recommendation. Okay. None of us know what we're doing. Otherwise, we wouldn't be making videos for or about companies. We'd be investing in them for a living. Okay. So no guarantees here, besides that there will be forward-looking statements in these conversations that you're about to watch or listen to. And those are conversations that are general and impersonal in nature, that are contain hopes for the future, events that may or may not take place depending on many different factors, both within and outside of the company's control. Be aware of that, and please talk to a professional investment advisor, as well as please do more research before taking any decisions in the end by visiting setterplus.ca, where you'll find the company's official findings. There's disclaimers on your screen right now, as I mentioned. If you don't enjoy losing money, read them and be careful out there. With all that said, as I mentioned, first company I'm going to be starting with is Founders Metals. They're a paying client on this channel, as I mentioned again. But to talk to them, I'm going to have to travel to a warmer place, with that being Suriname, to talk to Colin Paget, the company's CEO. And the company is listed as FDR on the Ventures Exchange in Canada, where an average of about 180,000 shares trade each day, with a 52-week high of 191 cents, otherwise known as $1.91 for normal people, and a 52-week low of 28 cents, with a market cap of about $110 million and about 62 million shares outstanding. Today, this is a $1.76 stock. There are about 10 million warrants, all of which are in the money right now, actually. So all of it is, forward-looking statements. You never know if that's actually going to come in, but were they to come in, that would be worth about $5.6 million. About 25% of the company, according to the latest presentation, is owned by management and insiders. 34% is in the hands of institutional investors. It might be a little bit different right now, but you figure that out as I update you more on it. Looking at the latest balance sheet, which is dated February 29, the company had about $4.3 million in current assets, most of which at the time, so about $4 million of which, to be specific, was in cash. Again, the situation is different now, though. No long-term debt at the time, but account payables and accrued liabilities did constitute about $2 million in current liabilities. That same financial statement also tells me that on average, over the last reported 3 months, founders spend about $245,000 a month on administrative expenses, which is about 4 times as much as the same period last year, which makes sense given how the drill program has ramped up and all that. Again, stuff that we'll talk about later on. Whereas an average of about $830,000 was spent on exploration and evaluation, mostly focused on that Antino Gold project. And so, to put it simply, this means that the company spent about $1 million a month over that last reported period. And I'm being rough with the numbers here, so that will be a rough split, about 25% going into G&A and 75% going into the rocks. I'll keep saying it though, but you need to understand that what I'm going through over here is only a snapshot in time. In this case, specifically at the end of November of last year, I believe. So please do head over to the company's website, as well as setterplus.ca, to look at all the numbers yourself and make sure you're getting the full picture, especially because, as I mentioned, there has been a private placement closed since this report. So it was to the tune of $10 million, all of which, by the way, bought by one entity. So hopefully we can talk about that later on. But the numbers as they are right now will differ from what I told you, but you can make that your own calculation in the meantime. Accounting is indeed probably the most fun you can have, but it's not the only fun we're going to have. It's not the only reason I'm talking to Colin here today. And if you're not well familiar with the company, there is going to be an in-depth interview linked in the show notes of this program, because Colin and I did a relatively deep dive not too long ago, so you can go and watch that. But again, just briefly, the flagship project is in Suriname. That's in northeastern South America. It's called the Antino Gold Project, and it's a relatively new gold discovery that is now being drilled out in an effort to define the resource there. And so Founders has the option to acquire 75% of this project, with stage 1 of the earn-in option agreement just having been completed. So the company now owns 51% of the concessions there. And yeah, Colin, I don't like a lot has happened since you and I last spoke, including that financing I just talked about, but also continued delivery on the project level from a drilling perspective. There's a discovery of a new gold zone. It's named Donut, as well as Froyo is getting better. It's good. A 250-meter depth extension, I believe. Just continued grades to the tune of 15 meters of over 8 grams, 26 meters of over 5.5 grams. There's also 38 meters of over, peeking at my notes, 10 grams, and 19 meters over 14 grams at the new zone, and so on and so forth. So you're just delivering on the project. You've now also bought a third drill. You already owned your own 2 drills before then. Now there's 3. So first of all, congratulations on all the success in closing this financing. And I'm not one to blow smoke typically, but you're doing good work, and the share price agrees with you, so you deserve praise. And yeah, you have, as I said, a lot going on, new money, new partner, continue delivering the project, new drill. What are you most excited about? What are you most focused on, or excited about right now?
Yeah, I mean, honestly, thank you. There's a lot to be excited about right now. So it's a bit difficult to choose. I mean, we're still having success with Froyo, working on that strike extent business. The donut discovery has been really exciting for us. We have some results coming out on that here in the not too distant future as well, as we've just kind of wrapped up our, I'll call it phase 1 of drilling at donut. And but really, I think the one that people are, myself included, excited to get down to is the Boise stuff. And with the third rig on its way, we're anticipating kind of towards the end of June having a rig down there and drilling. So looking forward to that. We've also, finally, especially with the added dollars in the bank account here now, have a proper team in place to start doing some of that ground exploration and building that earlier part of the pipeline as well. We've got several quite advanced exploration targets. All the upper Antino stuff, Boise, the lower Antino bit, and everything as well is, I'd say, quite well advanced. But now we're going to start getting to test all those things that we've been able to put together. So.
I do want to talk about all these things, specifically how you're going to be deploying the capital that you're now getting in. But I just want to talk about the donut zone, just to kind of maybe better understand it geologically, and maybe kick it off sort of from the top. Did you expect this? Like, did your geological thesis expect, I guess, donut to be what it's turning out to be? Because I thought it'd be sort of a bulk tonnage thing based on historic findings, or like what was the expectation? And yeah, talk to me about that.
Yeah, I mean, no is the short answer as far as expecting it, but pleasantly surprised, we'll say. No, we went there looking to follow up on some historic stuff. There were some shallow holes. They had 40 meters of 1.5-ish, 38 meters 0.9, like that kind of thing. And that's what we see, honestly. We see that in the grades and the tailings. They're very consistent, kind of in the tails, 0.5, 1.5. So it all kind of lined up with this intrusion hosted bulk tonnage, kind of broad low grade interval type model. And that's what we hit. We've already put out 7 holes to date on that. And we were hitting those 20, 30, 40, 50 meter intervals of the lower grade stuff. We had some visible gold in a couple of holes deeper down, which is always an exciting sign for things. And but it wasn't until we drilled holes 6 and 7 from the east, drilling west, and came through the intrusion and basically came right into one of these shear zones, much like what we see at Froyo, just a different sort of scale. But one of these shear zones at the margin of the intrusion, in contact with these volcanic rocks, and that's where that highest grade mineralization wound up being. Is 45 meters at 2 is the first hit, and the 19 of 14 right after that.
That's interesting, that last part that you compared it to Froyo. And do you think, which now that I'm saying it makes me think that someone is constantly hungry within the company, but you can, maybe we can see a frozen yogurt with donuts on top type of deposit, is what I'm thinking. Like, could that be a thing? Could the 2 zones meet each other at depth, or could it be that both of them are being fed by like one big intrusive or something along those lines, or is that just science fiction here?
Yeah, it wouldn't be fed by intrusive, like the type of deposit. Yeah, you'd expect, we're in this big broad shear zone type area. So I wouldn't even realistically, it's 800 meters across strike. So realistically, from a structural standpoint, I wouldn't expect them to connect at depth either. I would expect it to be kind of 2 parallel things, but driven by the same, overall broader geologic processes. And that's just being within these kind of secondary or third degree splays off of, the big kind of structural shear zone or regional scale structural shear zone that sits to the west of us. It's just the different rock types, be it, at Froyo, we're dealing with kind of quartz carbonate veins and gold in that, and it's very much a shear zone hosted thing. At Donut, you do get that, which is what we've come into with this high grade stuff at the margin. But the rocks are really what help make for bigger, broader gold zones. If you're where we have the contact between intrusive rocks and some of these volcanics, it's just the right blend that when you have the shears come through and mineralization, it tends to be broader. So, and we see a bit of that at Froyo. That's kind of why I mentioned that.
But in the Donut news release, you mentioned silicification and ceruticization. I believe I'm pronouncing that correctly. Is that alteration comparable to Froyo as well?
No, so that's very much associated with this kind of intrusion hosted piece. So that is one thing that's different. And so you think about the rocks in general, and because it's intrusion hosted, those rocks are maybe they're a little bit harder, they fracture differently, etc. And so and they compositionally probably have a little bit of difference to them as well. So in the donut scenario, what we see is a lot more fracturing, a lot more veining kind of throughout, and that's what does the silicification and allows for kind of intense ceruticization of the kind of entire intrusive body, and that's why we get the broader intervals of kind of lower grade mineralization with some nice high grade kicks kind of mixed in, but we get those broad intervals because of that. Whereas at Froyo, there's not a lot of kind of low grade shoulder on the zones. They're pretty sharp. You're in grade and then you're not in grade.
Well, what else is different here? Well, you spoke about lithology, I suppose, but sort of from mineralogy, stratigraphy type of outlook, what is different?
Some of the stratigraphy is pretty similar. From the mapping that we've done and we put together so far, it looks like we're in more or less the same volcanic package. Just the intrusive there is much larger. We don't have that same big tonalite piece associated with things over at Froyo. That's the big difference.
Why I'm asking these things is because, first of all, I was going in the realm of science fiction, hoping or thinking whether these two things can be the same. But also just thinking, is targeting on Donut going to be easier now that you know what you know from Froyo relative to as if this was just sort of a first time or a blind target, if you will?
A little bit easier because we understand the overall structural picture now a lot better as far as where we are in this bigger system. Like we put up a technical presentation on our website a little while ago, and one of the slides that's in there really shows this big antiform structure at kind of wraps around Upper Antino. And knowing where we are, at Froyo, we're on one of these limbs, where that northwest oriented shear zone is kind of coming up one of the limbs. At Donut, it seems like we're very much in the same sort of position. We just have a little bit different rock type, so a little different style of mineralization. That said, we're still getting the high grade stuff at the margin there. So yeah, I think understanding that has helped us target a bit better. But it's a little different deposit, just because of how it comes together.
There's also you mentioning that higher grade pocket that you're getting, or well, not pocket, but spots that you're getting basically. And I'm reminded again of something we talked about this last time as well, about Froyo. But there's with Donut, there's some great variability too, ranging between sort of ranging half a gram sometimes up to 8.5 grams, as you mentioned, then later on up to 14 grams. Has that already proven a challenge in your exploration efforts, and could it result in a challenge later on come time for PEA or even later than that production?
Well, to answer the last part first, I think it's too early on to really be able to say how that would affect the more global economics of things. But yes, it's a little bit harder to be able to specifically target the broad intervals because we do see these kind of higher strain zones, even within the intrusive, where we'll get these kicks of high grade. And so I think really the model winds up being that you have to take it as this kind of bigger bulk tonnage type target, where it's an average grade on the whole, instead of being, we've got this very well-defined zone that is, X. And I think that's the model that people apply to these things in general. So,
yeah. Okay. So, I mean, there's not, like, proving up continuity is not specifically a goal of your drilling. It's just you're going to look at it as a whole, basically, is what I'm getting out of it.
Look at it as a whole for sure. Continuity is always part of the goal, though, if we can put it together in a model that makes sense. and something we can continue to test and show that works. That's really what we're doing. The stuff at the margin, so that shear hosted stuff, that you would expect to be fairly continuous. And so, we're able to test and show that. And then the stuff within the intrusive, that's just a matter of getting enough holes in it to understand kind of what's there.
How do you, yeah, how do you follow it up? What are those holes to see what's there? When exactly, where exactly do you put them down? I suppose you're going to have a news release soon explaining or outlining exactly our plans, but what is kind of the rough idea here?
Well, I mean, so the first step for us, kind of coming off of those big hits on the last donut release, was understanding, how big is the intrusive itself? If that's having a big part of the control and the mineralization on that shear zone development, how big is it? So we've been testing kind of, the various dimensions, looking at defining that, and we've got a rough handle on it now. There's definitely more drilling to do on that front. But that also has kind of shown us that there's a margin on the east side that has, where you come into other rocks and into a shear zone as well. So there's a lot of potential on that side of the deposit or of donut as well, that we really haven't even gotten into, but it's things that have come out of the drilling we're doing. And then after that, it's really down dip and a long strike extension of the highest grade kind of localized shear or strain zones.
Okay. Do I wait for an interview based on that news release, or can you tell me how many meters you want to put in donut?
So right now we're looking at about 3,000 in this first round of drilling, and then after that, we're really going through to see how much we want to put into it, but we definitely want to do more.
Yeah. Okay. Have those recent hits changed your ideas to when you want to have your first MRE for the company as a whole out, or does donut not really change that perspective?
I think it definitely changes it. Yeah. Donut, as well as some of the kind of further afield, but still in Upper Antino drilling, definitely changes how I see a future first MRE. Things depend a bit on what happens down at Boise or elsewhere on the property, but I would say having hit the high grade stuff at Donut and seeing that there's a lot more up there, it probably does push out any sort of timeline for putting out a resource estimate. I mean, we now have, I think, a bigger scope to work with and really want to understand what's there with the drill bit before, kind of committing to any hard and fast timelines.
I'm reminded of Chief Brody here from Jaws, where he says we're going to need a bigger boat. And so for you, it's kind of like we're going to need a third drill is what's happening right here. And you bought your third drill. That's a nice segue for you. How much, what is, yeah, I mean, talk to me maybe about how much does a rig cost, by the way, in the first place?
The one we purchased, it's about a year old. This one's about $300,000.
Okay. So,
and then you buy we have a lot of supplies to support that as well, drill strings and all that kind of stuff. But yeah, for the rig itself.
And how much is that saving you per meter drilled, do you think?
I'd say we save, on the whole, doing everything ourselves, we save anywhere between 150 and 200 a meter. That's taking everything, kind of global costs into the whole thing.
But do you then have to drill a certain, well, you probably have to drill certain.
What's the payback period?
Yeah, that's what I'm trying to ask. I'm half asleep at this point, it appears, but that's what I'm asking. Thank you for doing the interview for me.
Yeah, no. Yeah, the payback period is pretty fast on these things. And in a number of ways, like there's the kind of per meter thing. So on just a straight per meter cost, we now have enough months behind us that we've got a pretty good handle on what things come in at. So that 160 to 200-ish dollar meter, that's kind of our range on a month-to-month basis. So that's Canadian. The US quotes that we had were 200 to 250 US per meter. So that difference is somewhere between $75 and $100 Canadian per meter we're saving just off the top. But the thing is, with those quotes with a standard drilling contract, there's a lot of extra costs that go into that, standby time and all sorts of things that we don't pay or we don't see. So ultimately, we're paying things back pretty quickly. So in doing, say, a 10,000 meter program, we're seeing that value come back, and then some.
Yeah, pretty rapidly too. I mean, because of how big you want to tackle this. Is it also quicker? Like, are you winning time in any way?
I don't know if it's quicker. I mean, at the start, there were definitely some kinks to work out. I mean, a drilling company's a whole other company. It's a whole other business. So at this point, with 2 rigs, and we got the crew training, but mostly trained for this third one arriving. So we now have a pretty good handle on what we're doing, and productivity is quite high. Whereas with a third party drill company, I mean, they know what they're doing and they come rigs in hand and ready to go. So I think down the road, if we're looking to expand, if we want to get much, much bigger, quickly, we probably would wind up supplementing some of our own drilling with some third party operator type work as well. I think that will wind up from a timeline standpoint, making probably the most sense to shareholders. I think that the speed at which we can drill things off and make new discoveries is really going to be a big part of the value creation, at least in the near term.
What is that speed? Like how many meters do you typically get out per shift?
Yeah, right now, per shift, 40, 50 meters per shift. We see a lot of days like that. So 212s per drill a day. And we've been averaging, we're full rainy season right now, so we're kind of 750, 800 a week for the 2 drills. So a little bit lower than those numbers. And then it's 1,000 meters, a little over 1,000 meters in the kind of dry season or rest of the time.
That's pretty, you said it's mostly volcanic rocks that you're drilling through, right? So it's pretty standard. I mean, I don't think it's
the driller side, I think I have it pretty good. Once people have the saprolite thing figured out, the recovery and that's very good. And then the actual rock itself has been stick rock, I guess as they call it. But very like near 100% recovery and just comes out very nicely.
It just comes out as a pipe, like it doesn't come out, broken up and stuff like that. Good.
Exactly.
Good.
And the pieces go back together if they are broken, and it's very nice rock.
But so you say that eventually you might want to supplement it with the drilling company. Is this kind of where you top out in terms of owning your own drills? Like you don't want to own a 4th and a 5th drill, or like how do you look at that?
No, I mean, I could see us definitely acquiring a 4th for sure, 5th potentially. I mean, I've kind of talked already about having up to 5 by the end of the year.
Okay.
On a few other places, and I still think that that's reasonable. After that, it really becomes just a decision for us, a trade-off. Can we do it? Absolutely. I mean, we've proved it at this scale, and we've got some excellent people working for us that have experience with some much, much bigger companies and drill programs or numbers of drills than what we have currently. So I think we have the ability to do it. It'll just come down to whether that's the best decision or not from a timeline standpoint.
Okay, Colin, listen, this is Canadian exploration. What you do is you set up a drilling company and then you charge I'm just kidding. Don't do that. But no, I understand what where you're coming from with this. How much will having this 3rd rig and then eventually 5 rigs, how much is that adding to your G&A, and is that accounted for in the savings that you're making that you just told me about?
How much will add to the G&A?
Yeah.
It won't really add much at all to the G&A.
Okay.
Because we're adding personnel that would kind of come under the regular drilling costs budget, but as far as additional management or additional kind of costs overall on the administrative side, we're not really looking at.
You don't need anyone to manage that because well, again, it's almost as if it's a separate drilling business, so you don't need anyone in the C-suite or anyone to manage that.
Not on the C-suite side or on the kind of upper management side. And we already have the people in place. Like their capacity presently certainly allows for a 3rd rig to come in without, stretching them too thin.
Good. Yeah. Well, it's, I didn't intend our conversation about the drill rigs to be that long, but it's interesting and just out of interest. How's the way your neighbors look at you or other potential buyers for this property? Has that changed? Like, or since you made the donut discovery, I mean, is anyone else coming up and knocking on your door or wanting to look at these rocks or like, yeah?
I mean, there's been a lot of interest, and I don't think it's necessarily just because of the donut discovery. I think the timing of that, but also with basically the Anglo coming in with G2, quite recently, and then all the recent news with Reunion and G Mining and everything. Just people are paying attention to the Guyana Shield as a whole, and when you start going down that list, a founder's name comes up pretty quickly. So, I think that's what's driven a lot of it. Donuts certainly it adds. I think it certainly helps for the scale piece because people, especially when you're on site. I've done a lot of tours recently, and when people are there, you see where Froyo is, you see what that 1.2 plus kilometers from the runway looks like, and then you see the donut's 800 meters across strike, on a whole other limb of this big fold, and it gives you that sense of scale, and yeah, that certainly resonates.
So what are the people that come knocking or asking questions? What are they saying? Like, are they saying, "Oh, get this to PEA, and we'll talk again," or get it to a PFS and we'll talk, or get it to that size? Like, what's the thing that they're demanding or asking about?
I mean, I think a lot of people actually are saying that we're pretty early on the kind of the exploration side of the Lassonde curve, or the value curve, and so right now it's don't rush to those things necessarily, and get out there and explore and drill as much as you can, and find what's there. That's what's really going to drive value. I think rushing into a resource, or ultimately PEA, well, valuable and obviously necessary components, just understanding the overall economics of it. I think finding the gold first. We've got quite a bit of runway on the exploration side right now. So
let the market guessing. It's working out for a couple of stories out there. It's working out for the snow lines out there. I'm not in any way comparing it or anything. Like, I'm just thinking out loud, basically. But
yeah, no, but it's true enough. I mean, you want to keep the upside or that kind of potential open, and not that having a resource means that there isn't more gold in the ground, but I think it can have sometimes that kind of, people see it sometimes as a cap. And I started drilling in the end of June last year, so we're pretty early on.
yeah, not even a year yet. It's 11
not
months.
Even a year. I know, it's wild.
Wow. Okay. What do you, and you're extending that Froyo zone at depth, as you said, it doesn't mean there's more gold. Apparently there is more gold that's showing up. Talk to me a little bit. I have a couple of questions about that, but talk to me about that depth extension that you expected. Is the thesis still checking out?
Yeah, I mean, as far as we can tell, I mean, right now we're limited to holes about 500 meters or so in terms of full length. So that limits how much of that depth extension piece we can do right now. So I think there's plans down the road for some rig with a bit more capacity for testing even deeper. I mean, these sorts of systems obviously can be pretty deep rooted. But after that, we've been focusing on the strike length piece. They're shorter holes, and we can do more of them more quickly. But it's building out to the north and to the south. And doing so right now, we're a couple months in now with oriented core. And that's also been a big part of helping the understanding even that much more, particularly the high grade, or targeting high grade. Being able to understand what these structures really are doing as we move along strike, it helps a lot.
How this third rig that you just bought, how deep does that go?
It's same type of rig.
Okay.
Yeah.
Right. So eventually, if you want to go, well, are you going to want to go deeper? Like, is this something that you want to drill to 1,000 meters?
I think ultimately, like, everybody wants to know if there's something down there, and it doesn't mean that you're going to drill it off to 25-meter spacing at 1,000 meters depth. It just, from a conceptual model standpoint, like the very deep holes that Reunion's done recently, it makes a big difference, to the overall numbers from the deposit, and shows that it is open, to that sort of scale. So, ultimately, we will want, I think, to test some of that.
Yeah. Men will literally want to drill 1 kilometer holes instead of going to therapy. I'm reminded of another meme there, but
Yeah.
so okay. When you're drilling deeper though, when you're going to where you are right now, are you asking for arsenic as it goes deeper, and are you expecting arsenic to be picking up at those depths?
No, we don't expect to see any great deal of arsenic really anywhere at the moment. Just the types of rocks that we're in. These volcanic packages don't typically carry a lot of arsenic, and we're not seeing that really in any of the multi-element work that we've done, and that's be that soils or just grab samples, or some of the drilling work we've done some multi-element chemistry on as well, and we just don't see much arsenic.
Anything else that I have to be worried about? Bismuth, cadmium, something else?
No, none of the deleterious stuff. And so we've actually just recently submitted 5 samples from the Froyo area, and then another 3 samples for the kind of some different tailings at Upper Antino, but for metallurgy. Yeah, well, we should have kind of initial cyanidation testing results. It's looking like towards the end of June, and then kind of the rest of the results from that sort of work kind of later in the summer. But we've recently put out a few images in one of the recent press releases that showed some microscope work on the gold that we see in the system, and it's by and large it's fracture fill in pyrite, or winds up being free gold in the matrix. And so I think, like a lot of the deposits down in this area, I don't see any issues coming up with the metallurgy side, but we will have the proper numbers soon.
How come, by the way, like why are there no deleterious elements? Is it related to the host rock or the mineralizing event itself? Like why is it clean, basically? Not that I'm complaining, I'm just wondering.
It is. It's dependent, I mean, on the source of your fluids. So intrusion related things, the fluids coming off of that intrusive body are going to be different. Metamorphic fluids, which is what drives orogenic gold systems, are largely just fluid coming out of, they can be sedimentary or volcanic rocks that have just gone through that green schist amphibolite facies transition. Basically, as they get hotter and more pressure is applied to them, different minerals are formed that don't allow as much water in their structure, and so that water comes out, and that it's quite clean. So it's a lot of basically source of the fluid, and then what rocks does the fluid that does end up being, what creates your deposit, what rocks does it come through, and the package that we have winds up, not driving a lot of those bad deleterious things into it. Yeah.
Okay, good for you. How do you having these multiple targets, as again across that package, it pretty much all looks good. Like maybe there's something that if you had looked at it two years ago, something like that, you wouldn't have thought that all of these targets are going to start checking out the way that they are right now. So how do you stack the targets in terms of priority, and how do you know, I'm going here first, and then I'm doing that much here and that much there?
Yeah, I mean, up until recently, that's been a real challenge, particularly like within, a lot more stringent budget constraints, I guess, and wanting to focus on the Froyo piece and build up that base in terms of what's there and understanding what's there. At this point, we prioritize based on really just the potential. So, getting to some of the areas where there's already been work done, and following up on new ideas and new things that we've had come out of our mapping or our soil auger or channel sampling work. I mean, that stuff's going to be priority for us. And kind of starting at the top of the list is Boise. Obviously, there's just so much potential there. And we've added so much to our understanding of the deposit, and quite a few new things from, the drilling that was done historically. So that for us is like, number one, easily. After Boise, we've got the things at Lower Antino, which is a phenomenal auger geochemical anomaly in terms of gold. We've done some recent channel sampling work and other mapping groundwork that looks quite good. We will have a release out here down the road. It's timing of all these things, getting them done, but on that exploration side to kind of show people what we're seeing in those places. So that winds up being kind of the next one, because it's also logistically simple. It's fairly close to where we are at Upper Antino. And then from there, it's testing things and just building them out. And I think we create a pipeline of things in an order of developed targets and start working towards drilling all of them, ideally.
Do you want to do anything crazy sort of call it? Do you want to step out a lot or go to a new target or something that you just so you can poke one hole, something that you haven't drilled before?
Yeah, I've got a couple of those. There's one that I'm really excited about, and we're waiting on some assays back on some samples, but so that we'll get a press release out on, but it's very far to the east. So you go, it's 6 kilometers southeast of Boise, and if you were to go another kind of 5 kilometers dead east of that, over in that direction, we found a couple of artisanal pits. When the guys went to kind of get into those pits. Along the road that have been created from the river, there's 2.7 kilometers of strike in this very, very silicified, intrusive tonalitic type rock. And one of the guys that went was Vincent, who did his PhD on the Yao deposit across the river, and he getting to the pit that kind of led to it. He thought that there were a lot of similarities there. So that has me pretty excited, particularly from a scale standpoint. Just walking over that much intrusive with, the potential for, a very large body. It's just an exciting one because it's very unknown. I mean, we're explorers, I guess, ultimately. So it's always fun to find something totally new, whilst, kind of maintaining our focus as much as is needed too on the primary targets.
How much of it, like how much of your focus would you typically, and your money, I suppose, is here an important question too. How much of your money would you typically spend on sort of wildcats or wild shot targets, if you will?
So something like that, like getting out to we've called there's two pits out there. We've called the Lawas, Lawa North and Lawa South. Something like that is it's an involved thing. So, I think finding something would obviously, it would generate a lot of value. So that's the trade-off. So I think, but it's far enough away from our kind of current logistical base, and we're going to make sure that we do all the steps in the right order. So we'll get out there and trench and understand it that way before we're actually taking a rig over in that direction. How do we attribute the dollars or to the wildcats or the targets out and around? I think really just has to be part of the budget. I mean, we've percentage wise, I think it depends a bit on what we're following up on based on historic work or whatnot. But I think that a lot of people would want to see, at least 20% of what we're doing is going into things that are completely new, completely out there. And that's why people get into the junior exploration space. I mean, we want to find new things. We want to build big things once we've found them, but we also want to keep finding. So
20%, yeah, 20% sounds reasonable. Is that 20% of the overall budget or 20% of the drilling budget?
Say exploration budget as a whole.
Exploration budget, yeah, let's call it that. Good. It's you said channel sampling and all these things following the steps. I suppose that includes geophysics. Are you doing more geophysics this year?
Yes, we are. Yeah, actually, that's so we're doing quite a big program. We're got plans to do EM survey, so airborne EM and magnetotellurics, but that's going to be property wide. And right now, it'll be a completely new data set over the whole property, and I think that gives us enough where we can start to see some of those bigger regional structures come out of it and can target from there. And combined with what we know from IP and we've seen in the ground mag and the historical regional mag, I think there'll be a lot of new targets generated from it.
When are you going to have?
Oh, sorry. I was just going to, so I guess to answer your question, when, right now it's just basically end August-ish, kind of depending on getting some clear skies.
Good.
Yeah, so it's likely the timeline.
Okay. And then with the 10 million that you raised, so mentioned at the end of the last period, you had like 4 million, but you're drilling in the meantime. How much money do you have right now? That's a more direct question, I suppose.
Like 12.5 million kind of thing.
Right. Your G&A is going to change a little bit, I suppose you mentioned at the beginning. I mean, the third rig is not adding to the G&A, but I think you mentioned, how much are you budgeting for G&A?
About the same as what you saw there. So we're getting closer, say about 1.8 a year to 2. Yeah.
Okay. Well, but that leaves 10 million bucks for drilling over the next 12 months, basically. Yeah. That gets you everything you just talked to me about and then some, I assume, but how far does it really get you?
Yeah. So, I mean, it gets everything that we've talked about, gets us over the line with the concession piece as well. So we've met the requirements for the 51% earn-in. You have to make a payment on that. But then it gets us through the drilling that we had planned as part of the 30,000 meters kind of coming into this year. I think it has enough there to add another 25,000 potentially, or we certainly have capacity for that. But that number really is going to depend on kind of how all of this other exploration work settles out. And we're really in the process now of putting all of the bigger exploration plans together now that we have the budget in place to do so. And that's, building a bit of a team to actually get out there and do the work on the ground. Prior to this, we would have been probably taking somebody from another job to go do some mapping or sampling somewhere. So yeah.
I think you're making other explorers jealous in this conversation so far multiple times. But that what does that mean for your news flow? News flow every couple of weeks, I suppose.
Yeah, I would expect something like that as far as news flow, and that's a mix between exploration, drilling, the corporate side of things with some developments as well. We already talked about we got metallurgy coming up. There's potential for some expansions of the concessions. So a few kind of press releaseable or notable things.
Is one of those news releases going to be telling me who gave you 10 million bucks?
Unfortunately, we're for their compliance reasons not allowed to disclose, but I think just the scale of the check and having it come from one entity is and no warrants again. So we've kind of maintained that and will do going forward. So
Why I really care is obviously, well, the optics of it all matter, I suppose, out there. But why I really care, initially, when I was prepping for this interview, I was thinking of asking you, because we had to reschedule it, whatever, and so you hadn't closed it back then, and I was initially intending to asking how many people are subscribing to it, because I'm just trying to figure out what happens in 4 months and 1 day, basically. But is this? I suppose you can say as much. This is. I don't assume it's a random entity like this. It's a natural resource focused entity. I suppose they're in there for the long term. What are they telling you?
Yeah, very large fund. They're in it for the long term and have a history of getting into stories, usually at scale, typically much larger scale even than what we did on this deal, and staying with the stories. So that's providing support going forward and continuing to maintain their position. So a very good long-term shareholder that's invested in, the potential and what they see Antino potentially becoming. So
good. Well, I'm not going to push you anymore on it. I respect your answer, and you got to do what you got to do. But eventually, we're gonna know. And I think a lot of people are kind of catching up on it on their own. But yeah, so we've been through Donut, we've been through Froyo, the money that you're spending, Waze, Laurentino, geophysics, metallurgy. What are we missing here? What else should we be talking about? What am I forgetting to ask you?
Not too much. I mean, I think we touched on the tailings piece when we last spoke. There's not been a lot of updates there other than we're kind of, I'd say, taking our time with it and to understand it as best we can before, really making decisions and doing anything. So the metallurgy work is going to be a big kind of deciding factor on what we may or may not do with tails. I think as we've worked along that process, come to really understand that it's potentially a big cash flow generator for founders. If we were to have a third party come in, which I've been pretty clear on, I think would be the only way that I would approach it, would be to have another operator come in and do that sort of work. That's still certainly a scenario that's on the table. But it's also could wind up being a lot of pretty fantastic additional mill feed down the road for a potential producing scenario too. So can't do anything but help.
True. What about everybody in the region? I mean, locals and governments and everybody's still happy with you being there?
Yeah, absolutely. That's actually one area that's progressed really well. The government, I was down and met with the president, be with 3 months ago, president and cabinet, discuss kind of what our plans are, and then also, what, they're willing to support with Antino. We represent an area that's, it's certainly important to Suriname. The interior, we're bringing a lot of, direct investment to the area and infrastructure and things. And so seeing support directly from the government for continuing to grow that kind of infrastructure in the interior. So built a new health clinic on the airstrip, local police station, that sort of thing. So Yeah, it's gone really well.
Okay. It is very positive. What about your option partner option year, like whatever you'd call it, now that you're over 51%? I don't imagine they're unhappy with whatever's happening there. But how's the relationship progressing there?
The relationship's very good there. We've right out of the gate, it's things have gone really well. I mean, they're a large part of why we've been able to, or how we've been able to do so much in a fairly short period of time, and they continue to support us that way. Right now, so as far as the 51% goes, we've met the requirements. We haven't officially gotten over that line yet, so there's a couple of kind of legal steps or accounting steps, but I'd expect that full announcement here in the not too distant future, just for clarity for viewers. But no, that relationship, they're very happy with how things have progressed, and a big thing for them is they wanted to see something develop there. They've been working out there, had those concessions for nearly 30 years, and so this has always been their goal, dream, I think, to really see it develop and move forward, and so they're very pleased with the progress.
What other extra steps do you have to take here to get to that? I was under the impression that everything's completed.
So we have to basically just have to have an actual, like an auditor, our auditor, provide them a letter showing that we've spent the dollars that we've spent.
Bureaucracy.
Exactly. I mean, I have no problem saying that we're well north of what we needed to spend as far as getting that done. So it's just a matter of going through the motions.
Do you think there is ever going to be an opportunity for you to renegotiate this and go above 75%?
Yeah, it's certainly possible, especially with it converts to JV, and then there's that kind of proportional contribution piece, which would, without them contributing at scale, would see them diluted down. So I mean, there's probably a lot of merit to potentially trying to acquire some more of that earlier on. Yeah, even from their standpoint, I think it could be a positive. So yeah, it's something we've touched on, I guess.
Okay. Well, but it's also far in the future. I mean, all the other things we previously talked about are more pressing and happening sooner. So I suppose. But yeah, Colin, this has been a very good overview. I don't think I have anything more to ask you about right now. I hope we can do this again soon and get more updates because you have a lot going on.
Sure.
But if anything else to add here at the end?
Honestly, I think we've covered it all. Like there is a lot coming up here in the next little while. That have pretty steady stream flow or news flow, and yeah, people just keep an eye out.
All right, thank you, Colin. I always appreciate our conversations. This has been fun. You're doing good stuff, as I said, so it'll be interesting to follow along and see what you're achieving there, and hopefully soon again, because you said a lot of these to talk about. So yes, I'll let you drop off now. Thank you so much for doing this, and I'm gonna move over to the second CEO barbecue for this week, for which I'm gonna travel. Actually, not too far away, so far away though, but I'm traveling to Bolivia to talk to Andrew Williams and look at a not what you think, or it might be what you think. I don't know how much Netflix you watch, but I'm looking at 3 silver projects, one of which, by the way, is the country's largest silver discovery in the last 30 years, supposedly is claimed by the company. Also, one of the larger primary silver discoveries on a global scale, apparently, and it's currently owned and being developed by New Pacific Metals Corp. Company is dual listed, with that being NEWP on the New York Stock Exchange, so that's NEWP on an ICA. And it's also listed as New AG, so NEWAG, and NUAG on the Toronto Stock Exchange, where an average of about 110,000 shares trade each day, with a 52-week high of $3.64 and a 52-week low of $1.25. With a market cap of about $480 million and about 171 million shares outstanding. Today, this is a $2.80 stock. Adding options and warrants to the mix here, of which there aren't all that many, by the way, combined, that leaves us at about 177.5 million fully diluted shares. 27.5% of the company is owned by Silver Corp. 11.5% is owned, 11.5% is owned by Pan American silver, and another 11.5% is estimated to be owned by institutions. And then there's just over 7% owned by management board and insiders, leaving something among the range of 40 to 45% in the hands of retail investors. Looking at the latest balance sheet, which is dated March 31st, the company had about $24 million in current assets, most of which, so that'd be $23.5 million to be specific, was in actual cash and cash equivalents. And it was topped up, as always, by some account receivables, prepayment of expenses, and short-term investments as well. No long-term debts and account payables and accrued liabilities ticked in at about $800,000, so nothing major to write home about. That same financial statement also tells me that on average, over the last reported 9 months, New Pacific spent, again, an average of about $400,000 a month on administrative expenses, which is actually a bit less, call it 10 grand or so less per month on what I call bureaucracy than last year. And of course, I'm not counting share-based compensation on here and stuff like that. To put it simply, this means that, again, excluding share-based compensation, and I'm rounding up, the company spent about $800,000 a month on average over the last reported 9 months, about 50% of which went into the ground, and about $390,000 per month, mostly in the form of project management and support. And the other 50% was spent, again, on what I would call bureaucracy. I always say this, and I always will, but you have to understand that this is really only a snapshot in time, in this case, specifically at the end of March this year, and the finances will have changed by the time you're watching this. So please head over to the company's website as well as setterplus.ca to look at all the numbers yourself to make sure you're getting the full picture and that you're up to date. We all know, especially with Andrew's background, that accounting is one of the greatest pleasures in life, but that's not what we're talking about here today. Not the only thing, because again, I have with me the CEO of one of the companies that owns the most significant, or the company that owns one of the most significant silver discoveries in Bolivia in a long time. And that project is called Silver Sands, which is located in south central Bolivia. That would be Silver Sands was New Pacific's entry into Bolivia, into the Bolivian precious metals market about 6 or so years ago, and they now own 100% of it. And about a year and a half ago, the company brought that project to the PEA stage, which is where it is right now. That PEA shows the potential for this project to produce up to 12 million ounces of silver per year in a doré bar end product for an LOM of 14 years in an open pit setting, given the deposit's location, which is on a mountaintop, basically. It's also, just FYI, at about a 4,000 meter elevation, and so it is close to surface. Yeah, I suppose it's above the surface because it's on a mountain, but for all intents and purposes, it's close to surface. PEA was done with a sensitivity table in it, as it often is, which this sensitivity table, the closest I can see on there to the current price of silver was $27 per ounce of silver. And so at $27 per ounce of silver, Silver Sands, so this project has a post-tax NPV 5 of about $1 billion US, or call it 1.4 billion Arctic pesos, if you want to call it that, Canadian dollars. And so a 50% internal rate of return at that price, and that is happening after a $308 million US, that is upfront capex spent, most of which is expected to go into the build out of a processing plant. And there's also a $20 million US sustaining capex, most of which is also expected to be related to processing expenses as well as tailings. With the upfront capex expected to be paid back in a bit under 2 years. So that's the payback period here. The goal, of course, is to move this project to the PFS stage potentially by the end of this year. So it is going to be something that we're going to be talking about in this interview. And although the most advanced asset, Silver Sands, is not the only project that New Pacific owns, though, they have 2 other projects, namely Carangas and Silver Strike. Carangas is also an advanced stage project. It is a few steps behind Silver Sands, as it is currently at the MRE stage, and it houses over 560 million ounces of silver equivalent in the indicated category and 110 million ounces of silver equivalent in the inferred category. Geologically, similar, but also a little bit different in that this is hosted within a volcanic system, so it's under a volcano, basically, and mineralization occurs in layers, with there being 3 main layers identified to date, where the top layer is mostly where the silver is. Then there's a zinc and a lead layer sort of in the middle, and then the third layer is a gold layer that is found at about 1,000 or so meters from surface. So this was to be, if or when this was to be mined, it would be an underground setting for that gold that's there, but potentially starting with an open pit or not. Again, stuff that we can discuss later on. because of this polymetallic nature of the deposit. Recoveries here will also be different or require more processing, which is again something I hope we can touch upon later on in the conversation, as the project is expected to cross over into the PA stage later this year. So that's when we're going to have more information on it as well. The third and the least advanced project here is Silver Strike. It's also in Bolivia. It's on the western margins of the country, so north from Carangues, or about 450 kilometers northwest of Silver Sands. Not a huge land package. It's at about 45 square kilometers. It is also high up in the mountains. It's between 4,000 and 4,500, excuse me, meters of vertical elevation. And New Pacific did poke a few holes into this a while back, but outside of a bit of a better understanding of the geology, there wasn't much else to write home about. So the project is, for the time being, on the back burner, and exploration activities here are paused, so to call it, to focus on the other two projects that I talked about. So plenty to talk about. I'm running out of breath, and so we can definitely fill in an hour of questioning here. But before that, Andrew, you don't look at, and I mean this in the nicest way possible. You don't look much older than me, but you're running a $500 million company while I mostly spend my time in a little dark room clicking on a keyboard. So I was thinking of asking you where you found the magic fairy so that I can go and look too. But seriously though, we typically don't see people your age running companies this size, at least. Typically, I guess, because experience takes many years or even decades to build. So what makes you think, what makes the board really think that you're the right person for the job here?
Well, hey, thanks, Antonio, and just great job on the introduction. I think you did a very succinct overview, and also don't sell yourself too short on what you're doing either. But with all that being said, no, it's a great question, fair question. I think, I mean, I joined the company in January of last year, so I've been with the New Pacific for almost a year and a half. But I joined as the company's president, and working with the previous CEO, and really, coming on board, using my background, which I can get into, about on the finance side of things, and helping to play an important role as our company transitions from being an exploration company into more of a project development focused company. And so I was in that role for about 9 months last year, and I suppose that through a sample of work that I had performed, the company had enough, or the board had enough confidence to promote me into the CEO position in September of last year, and I've been in that seat ever since. So I think talking about what ultimately gave them confidence in my ability. I think, yes, I'm young, but I've also seen a lot in a very short time in the industry. Starting through it like you as an accountant back in the day, but spending an intensive almost 11 years at a precious metals focused investment company, seeing the world, traveling to 100, let's say, different site visits, meeting the industry, learning really a lot in a very short amount of time. I think it was a very accelerated learning process that I think I brought a lot to the table, joining in January of last year as a president, and continue to prove myself to the board to the point where they were comfortable enough to promote me to CEO in September.
Mm. And also, for the record, you were actually a real accountant. I was never that. I just went to college, and I never actually, I worked for like 2 months, I believe, and then I was like, okay, no, out of here. And I went to make YouTube videos, I suppose, which my mom is very proud of, as you can imagine. Anyways, you're also one of these rare breeds of people who are originally from Vancouver. So that's typically not the case. I suppose that's also part of it. But you also, like, you don't get your start as a CEO in, say, a BC story or something else, like Quebec, or something more predictable. I mean, from my brief experience of looking at mineral resource projects in Bolivia, I'm under the impression that it's kind of like, sometimes it can be like Russian roulette. Like, in one day, mining can be the country's brave hero, pulling a large part of the GDP and the employment, and that is the case right now. And then the other day, your assets are under state control or being blocked by indigenous communities, or a highway that you had expected is no longer getting built, or whatever, something along those lines. So talk to me about that too. I mean, operating in Bolivia, especially given that this is one of your, first endeavors in the space, and how much of a risk you really think that is.
Yeah, so I mean, it's a great question, and I think the way I've come to appreciate risk after, especially with my time, as a investor portfolio manager, is really like risk in our sector is the permanent loss of your capital. And like, I mean, I agree with you, and I'm not gonna debate you otherwise. That if you're operating and you've got a very secure project in, say, Canada versus other parts of the world that are maybe thought of as more frontier markets, like I mean that's the position you'd like to be in. But what I've found is that if you go back to defining risk as the permanent loss of capital, I've seen countless stories where, based in Ontario, Quebec, Western Australia, Nevada, that have permanently wiped out their shareholders. And what happens is when you get fixated, I'm only going to invest in certain jurisdictions, what ends up happening is you take on an inordinate amount of technical risk. And again, I don't want to name names, but I mean, there's been recent examples in Ontario underground mines, open pit underground mines in Western Australia, Nevada, that have been financed. You slap on a bunch of debt, you assemble a management team, you build the project, and you press play, and guess what? The geology is not what you thought, or the metallurgy is not what you thought, and you got bills to pay, you got debt to service, and you go from a dollar to 1 cent. And I've seen that time and time again, and often leading up to the financing and the operations, the company promotes themselves as, hey, we're in this really safe jurisdiction, and therefore everything's going to be okay. And so that's the one element. Of course, there's instances where you have a great project in a jurisdiction like Canada or Western Australia, and it's a great project and it works well, but then you're also stuck with holding your nose at a astronomical valuation that really erodes any of your possible return potential. And so I've seen that scenario as well. But I've also seen more and more instances where if you go to a jurisdiction, let's say you're in Latin America or you're in Western Africa or other less traditional jurisdictions, that the most important thing as an investor is that you're chasing high quality projects where, unlike those projects in Ontario or Western Australia or Nevada that have a high degree of technical risk, right? You go to a jurisdiction that you're taking on a little bit more risk, you better be damn sure that, from a technical perspective, you're going after a special deposit. And so that I've seen play out in many different instances where I think there was a year, maybe it was 21 or 22, and we did an exercise where we looked back at, say, the last 2 or 3 years of investment returns across all the different companies in the sector. And the ones that were really standing out were companies that went after great ore bodies in more frontier jurisdictions. And the ones like Lundin Gold was just a beautiful example, where they took a world-class deposit. They acquired it in whatever it was, 2013, 14. Everyone thought they were nuts going to Ecuador, and they made it work. And that's been a really wonderful success story in our industry. We've seen some examples in the Australian market, guys going into different jurisdictions and getting the job done. Again, going after great ore bodies that have a much lower degree of technical risk, finding a way to make it work, and financing and developing and creating huge wealth. Western Africa as well. I mean, the playbook, you look at someone like Mark Bristow, Randgold. I mean, that's what he did. Went after world-class deposits in less traditional jurisdictions and created a huge amount of wealth for shareholders along the way. And I think that's really the point that I like to emphasize is jurisdictional risk is a flavor of risk. Like, there's no doubt about that. I'm not going to debate you on that. But again, risk is risk, and risk is the permanent loss of capital. And you start to look at where the capital really has been lost over the last several years, and where the big gains have been made, and it nuances the picture somewhat. And that's why you talk about our Silver Sand and our Carangas project. I mean, like Silver Sand, we've got economics out. It's a phenomenal project. This is one of the best primary silver discoveries that's been made anywhere in the world. in the last decade. And so, that's the prize that we're going after. And we think that, when all is said and done, it's going to be worth the effort.
It, I suppose, and we're going to talk about the specifics of the projects that you have there later on, because you're right. I mean, the project, and that's where I like starting. I like starting at the asset level. That's what I like looking at first. And you've probably been asked this before, these questions that I'm coming up with here at the beginning as the barbecue is kind of warming up, if you will. You've probably been asked this before, but also when I'm thinking about Bolivia, topography jumps to mind. As I mentioned at the beginning, it's basically a mountain for the majority of the country or something like that, especially where you are. And as I said, 4,000 meters, 4,100, 4,500 meters of elevation is where your mind would start if built. How much of a challenge from an environmental or labor or technical perspective do you think that can be?
Yeah, it's definitely a consideration, and just want to as well, 4,000 meters. But it's funny, both our Carangas and Silver Sand projects are at that same elevation, but vastly different geographies. If you go to visit the projects, our Silver Sand is more mountainous, more sort of rolling hills, but certainly more pronounced mountains. But it's not like you see the big image of the glacial peaks like you would say in the Andes. That's not the environment where our Silver Sand project is. Lots of sort of shrubs and bushes, and sort of in the rainy season it's green throughout. But our Carangas project at 4,000 meters, it's mainly flat. It's in the Altiplano part of Bolivia, which is generally, if you go drive across it, you can bomb down the highway at 140 kilometers an hour, from our Silver Sand project to our Carangas project, and you get there in about 12 hours. And it's not like we're kind of traversing through difficult mountain passes. It's actually fairly level for the most part in that Altiplano part of Bolivia. And the really interesting thing about Bolivia is, and actually, coincidentally, when I was in my 20s, I went on a backpacking trip through South America, which included a stop in Bolivia. And you go into the capital city of Bolivia, in La Paz, and the airport's in El Alto, which is probably 4,000, 4,100 meters. And you get off the plane, you get that shock initially where you're kind of catching your breath somewhat. But it's fascinating. You can take an airplane, 40 minutes and get off that Altiplano, and the remaining eastern part of the country is all jungle, right? So it's a very interesting and dynamic landscape across Bolivia. But going back to your question specifically, will this impact our operations? 4,000 meters for a Bolivian is almost like their version of sea level. I think, again, a lot of the population that exists in that Altiplano region at 4,000 meters, that's just in their blood, and really not seen as something that would cause a material issue when we go to start operation. You just look at the mines. I mean, I'm not just making this up. You look at the projects that have successfully operated in the Potosi region, where our Silver Sand project is, over the last 20 years, like San Cristobal, 50,000 ton a day open pit mining operation. San Bartolome, so a major milling facility, sort of open pit like operation in Potosi, 4,000 meters, and Pan American Silver's San Vicente operation is at that elevation as well. So it certainly it is an issue. Like when we get into the country, we usually like to give ourselves a day to acclimatize before going to the site. So there is some adjustment that needs to be made, but it's not something that by any stretch of the imagination is an impediment to a successful operation.
Mm. Is there enough people there that, again, you're going to have skilled labor, but not too many people where it's going to be a problem to have a mine in the first place?
Yes. That's honestly one of the most pleasant surprises that I've encountered since being there, is that Bolivia it's a mining country. Right? They've been mining there for 500 years. It's I think it's almost half of the country's exports come from mining. It's like 8% of the country's GDP. Like it's very much embedded in that country's DNA. And so as we've been over the last year and a half, bolting on our development capabilities as a company in the country, we've been able to bring on some fantastic people that are very familiar with the permitting landscape, the political landscape, and sort of community relations in that side of the business, as well as engineers. Like there's some really good mining people that are in Bolivia, and it's actually been a really a pleasant surprise for me, just being able to find these folks that are like I said, there hasn't been a new project built in Bolivia in the last 10 or 15 years. And so the folks that we're hiring on, they really do see it as a mission that they're on, and they're very motivated, and they see this as a meaningful opportunity to create something that is lasting and tangible and beneficial for the country. So I'd say that it's probably in a, like you said, the sweet spot where there is an abundancy of good people that know the mining industry well. But it's also not, it's not like we're in, say, like a metropolis or something where you'd run into issues trying to move 1,000 or whatever 10,000 people.
I also asked about environmental considerations, mostly because I'm thinking about water, both as in the availability of water, but also you using that water sometimes. Like so far, let me explain where I'm coming from. So far, what I've seen sometimes in South America as a whole is that some projects are struggling because of the lack of water, and other projects are struggling because there is water, but then the communities get pissed off when you actually use that water for mining instead of farming. So yeah, talk to me about water as a whole.
Yeah, and it's no different in Bolivia, right? I mean, water is sacred really anywhere in the world, and but yeah, our silver sand project is located in this area. It's kind of rolling mountainous topography that for 9 months of the year is very dry. There's very little precipitation, and then there's a very distinct wet season that happens about 3 months of the year. And during that wet season, they get like a meter of rainfall. Like it really rains hard in the area during the wet season. But what happens is that there's so much water that falls in the area, and it all eventually drains itself through the sort of the creeks that run through the water basin, and most of it, because there's an abundance, just ends up washing into the ocean and really doesn't get used whatsoever. And then during the remaining 9 months during the dry season, there's not enough water, and it's everyone's is trying to find ways to find new reliable sources. And so what we've proposed as part of our silver sand project is firstly to go with a dry stack tailings facility. So we will squeeze the water out of all the tailings that we produce, and really it's a wonderful way to recycle water. But to actually get that water source is build a water dam, and there's a mountain that sort of flows down on the western part of the silver sand project and sort of pinches into a valley. So it's a perfect spot for us to build an engineered facility that will capture a few million cubic meters of water that will fall during the rainy season, that we'll be able to store, and there will be water to use in our processing facility throughout the year. And then why that creates a win-win with the area is that there's also going to be additional stores of water available during the dry season for those in the area that will be able to share, and ultimately it will create an important piece of infrastructure that will exist not only during the mining operations but be there for the benefit of the communities for sort of into perpetuity, for long after the mine is closed.
I'm kind of throwing objections, if you will, specifically about the country at you here, and see what you come up with. And one other thing, so I'm explaining why I'm kind of jumping through with it, but it's going to make sense here in a second. But one other thing, some of the other discoveries in the country have undergone scrutiny, you could say, because of the contents of the nasties, if you will, in their discoveries. So talking about arsenic, mercury, bismuth, antimony, cadmium, and whatever else. And so I suppose you're asking for those too. I suppose you have to. What kind of values are you coming up with at Silver Sands and Carangas so far?
Yeah, I mean, silver sand is a very unusual deposit. Like, it's silver and it's pure. Like trace elements, everything that I mean, there's nothing that we've detected. Of course, we sample for all those elements, but nothing that would cause difficulty for us to produce a saleable doré bar, that's the flow sheet that we're moving forward with at the Silver Sand project. And so from a metallurgical perspective, we don't have any specific concerns. Like it's actually, I mean, the only, going back to your comment about what impact does the elevation have? I guess I skipped over one detail. This was before we did the PEA study, where we were debating whether or not to go with a heap leach operation or a milling facility. But at the end of the day, we figured we get the economics make sense of the milling facility because, again, the process is clean and we can produce this nice doré bar in a confined area, which we would still do with a heap leach. But because we're at 4,000 meter elevation, there was question marks about the reduced oxygen content in the ambient air and how that may or may not impact the leach kinetics with our silver sand project. But at the end of the day, we decided to go with the milling facility, and really nothing that would cause us any particular concern. I think it's more crush grind, traditional Merrill-Crowe produce doré bars precipitated from zinc dust. Carangus is different. So as you alluded to, Carangus is a polymetallic system. Again, going back to what is in that concentrate that could create difficulties for us to be able to produce a marketable concentrate. I think that's again, all the testing that we've done so far, we've yet to see anything that would cause us concern. Like I think the test work that we did for the pre-resource as well, we're doing additional test work today to support our upcoming preliminary economic assessment on the Carangus project that we expect to release in Q3 of this year. And we really haven't found anything whatsoever that would cause us questions. I think really our discussions with Carangus is more about how do we optimize the economics of it, because we've got this silver rich layer at surface, and this sort of zinc layer in the middle and the gold zone at depth. The gold zone starts at about 300-400 meters depth, not 1,000. It does extend down to 1,000, but it does start probably around 300-400 meters depth. But how do we optimize this? Do we float a concentrate? Do we cyanide leach the concentrate to pull the silver out? What do we do with the zinc? Are we going to produce how many different concentrates? Are we going to go after the gold zone? If so, do we? So that's more the metallurgical discussion that we're moving through currently with our Carangus project, but nothing on the order of magnitude of, oh my gosh, there's nasties in the ore and it's going to be impossible for us to produce any sort of saleable product. I think everything that we've seen so far across both projects is encouraging.
I do want to get a little bit deeper on that, but just one note that you made there. Q3 is when you're targeting PEA. I think initially it was the first half of 2024. It's being pushed back? Why? What's happening?
Yes, that's a good observation, a fair question. So we put our Carangus resource estimate out in September of last year, and it was a big resource, right? 250 roughly million tons. Compare that to our silver sand project, which was roughly 50 million tons. So 5 times the amount of tonnage in our Carangus project as our silver sand project. And one of the things that attracted me so much to and what I love about the silver sand project is that it's 50 million tons. So you optimize it at a 4 million ton per annum processing rate. You keep the capital manageable. You build it. You get a fast payback, and you're off to the races. It's a very financeable, buildable project. And so we looked at Carangus, and 5 times the size. So you're going to need to optimize for something that maybe isn't 5 times the size up front, but you got to build maybe something that's 2.5 times the size up front. And then in year 3 or 5, you got to do another big expansion to help drive the economies of scale to ultimately bring the cost profile down to maximize the economics. And so that was the approach that we ran with early on in our Carangus PEA. And we got some good NPV numbers, no doubt, with that scenario where you sort of just unconstrain it for capital. But we sort of figured there's the nice thing about Carangus is that because it's layered, so you've got, of that 250 million tons, there's 150 million tons in that silver zone that's right at surface. But in addition, there's about 60 million tons within that 160 million ton silver resource that's got even higher grades, and it sits right beneath surface. And so we said, well, hang on a second. What if we just focused on that upper lens, say 50, 60 million tons, and put forward a development philosophy that was more akin to our silver sand project? And so we ran some preliminary numbers and had a much more interesting scenario that sort of fell out of the analysis. And so what we've committed to doing here is, for our PEA study, we're going to focus just on that upper higher grade lens and put a project together that's more silver sand in scope to help have that same profile of lower capital cost, faster payback period on capital, boost the IRR, that ultimately is a more buildable, realistic project. And then what we're going to do in chapter, 24 of the technical report, is we're still going to show the big unconstrained NPV project to just showcase the two different scenarios that you could pull off the shelf at Corangus, depending on what your objectives are. If you're looking to get into production and finance, then you go with the smaller scenario, which is what we're going to really engineer, versus if you're a BHP, a Rio, a Barrick, or a big company and you've got no constraints, then we'll also show the maximal NPV scenario. And so that's going through that process. What cost us a few months compared to our original schedule, but the end product we feel was well worth the extra time.
Is it also going to cost you more money than what you had initially budgeted for?
For the technical study?
Mm-hmm.
Marginally, like maybe if it's, I don't know, yeah, it's not going to be a material change. I think we've sort of, what we did is we really run the bill up is with the consultants. And so we sort of went through this. We sort of paused it for a second, did a lot more internal thought analysis. And so then we sort of came up with our preferred scenario and have, gone back to the consultants. But, so there was some element of cost management involved. So no, it's not going to result in a material increase in the cost.
Well, you're also well covered in terms of expenses. That's something I do want to talk about. I want to talk about money later on as well. But to go back sort of to the specifics of Corangus, it's particularly interesting because, as you mentioned, this layered layout, if you will, which is also characterized by different styles of alteration. So different mineralogy, basically, of what's happening down there. So what you just told me about the nasties, or previously told me about the nasty, about the deleterious elements, does that include all of the layers, or where is it coming from? It's potentially now some more expensive, I assume, to do all these studies, or like, how does that work? Talk to me about that.
Yeah, so just to be clear, I mean, the nasties, we haven't found them anywhere in Corangus. It's more so a question of economics. So again, in that upper silver zone, actually, I'll first just take a quick step back. That lower gold zone is we made the discovery there, like we were drilling like 500 meters at 1.2, 1.3 grams per ton, initially. And so we thought, okay, let's go run a few quick samples just to make sure that this thing isn't, say, refractory. And we came back with very strong recoveries. And so I think we did another test and we said, okay, hang on a second, let's focus on one that's got a higher degree of sulfide content. Maybe we just kind of got lucky, and we ran that study and we got, again, 98.5% in these bottle roll tests on the gold zone. And we thought, okay, what's going on here? And we subsequently completed a microscopic analysis of the mineral content in the ore, and we've learned that gold is actually free gold hosted in electrum. So again, it makes sense why we get such strong recoveries in that gold zone. And then in the silver zone, though, that's where so there's right now our proposed flow sheet is to so flow to concentrate to pull the silver and the lead out. So we'll have a lead zinc concentrate in about whatever it is, 10% of the mass. And then the tails there will go to a zinc concentrate circuit, and we'll flow to zinc concentrate and then market that. But within that silver lead concentrate, which is where the bulk of the value is, what our analysis right now we're working on is that the end product, right? Is there, I mean, there's going to be some nice silver content in there. Does it make sense for us to just ship that out to a smelter? But the downside to that is that you're shipping more material. You got to pay the treatment and refining costs, and your payabilities aren't quite as high as if you say produce doré. And so on that silver lead concentrate, what we're evaluating right now is if we can put a small leach circuit, because again, that's only about 10% of the overall mass. And can we leach that concentrate to pull the silver out and then produce a silver doré bar and market the remaining silver deficient lead concentrate alongside the zinc concentrate. So we'd end up with 3 different products. And the other sort of couple more nuances to this whole equation is that number one, in Bolivia, you get a 5% reduction in your mining taxes if you produce a finished product like doré. So that also factors into the calculation. And secondly, there's also a new zinc smelter that is being proposed in Oruro, and it sounds like it's in the advanced stages. It's been in discussions for a long time, and so for us, when we're marketing our project and socializing it with the governments, it also, the more concentrate we can produce, it also gives sort of some more political will to help push our project through the sort of the permitting phase. So again, lots to be considered. I think with Carangas now, the metallurgical studies, that's our most significant expense that we're incurring doing the additional test work. And we've got a wonderful PhD metallurgist that's on our staff here that is leading this process. But that's really what we're investigating right now for the PEA. Probably the biggest question. We've sort of solved the question about, okay, let's focus on the higher grade lens that can be a more buildable project. Now we're really doing the detailed assessment of what flow sheet makes the most sense, and we're getting test data that's coming in real time, and that just is all part of the optimization exercise that we're doing.
Something like Carangas, is it tougher? Because you brought up communication, and that kind of made me think about marketing to investors as well. Is it tough to communicate to the market again? Because in my rather brief experience in the space, because of its polymetallic nature, it's tough to, like, silver equivalent grades before we communicate it, for example, to communicating those to the market is, well, sometimes it's frowned upon, right? Depending on how you do it with the pricing and all that. So how do you manage that? And is it tougher to communicate this?
Yes, absolutely. There's nuance, right? And nuance is just requires more context and more discussion. Versus like, okay, Silver Sam, we're going to produce a silver doré bar, and here's the juicy part of it. We're going to optimize a pit, and off we go. Versus, yeah, Carangas is, we've sort of gone through this exercise of what the best scenario is, and yes, it does take more marketing to and discussion to convey the message, but it's also valuable. I get good feedback from investors and about what they like, what they don't like, and I think pretty unanimously there's a lot of support for the staged approach, right? Where we build the small project, and again, just because we commit to a smaller project doesn't mean that we sterilize everything that's at the bottom. At any point in time when gold's hot or whatever it is, you can commit to the big expansion. But your point about silver equivalent, yeah, I mean, we have the debate. There's a couple of directors, one in particular on our board, that very much is not in favor of reporting silver equivalents, but it's just kind of been convention that we've done in the past, and we figured once we finish drilling, we'd potentially get a little bit more nuance. But your point taken. I think that the thing that going forward with this scenario, yeah, we'll probably get more deliberate with and specific with how we report. I think that the silver equivalent grade is helpful when you have these different layers, right? When you have the upper layer, the zinc layer, and the gold layer, it kind of equalizes all three. But if we're going to maybe focus more on that upper silver layer, then maybe it is, we will probably get a little bit more just, here's the silver, here's the lead, here's the zinc. Because I do understand the point that silver equivalency is can be frowned upon.
I'm hearing you speak, and you do a very good job of pitching the story and explaining what you're going to be doing. You clearly know the story well, and you have a very clear plan, which I can appreciate. But I'm also wondering, who are you doing this work for? As in, like, will a retail investor actually care about all these improvements, especially given where you're going to end up at with this project on the Lausanne curve? Or is this something that's related to, I'm looking at the SEDI filings, for example, when there is, when I see insider buying that comes from Silver Corp Metals, I raise an eyebrow. I see Pan American Silver in there and I raise an eyebrow, knowing that what they've previously also said themselves is like, they're great assets, but they're early stage. We'll look at them, it's going to make sense for us maybe at a later stage. So is that who you're doing this work for? Or, yeah, again, who are you doing this work for, basically?
I mean, it's a great question. You're gonna hate this answer because it's so cliche, but as shareholders, of which I'm one. But look, at the end of the day, I'm a firm believer, and it goes back to sort of my upbringing, if you will, my last role at fund. We were just so value focused. It was so embedded in our fund's DNA, like sort of cut through the noise, tons, grade, recovery, ounces, and get your permit and finance, and that's how you create value in the long run. The shareholders, the share price will follow that trajectory. So I do think that that's our laser focus right now, is to do the technical work, continue to progress our environmental permits, and the value itself will sort of fall from that naturally. Whether it's for we hope that we can. It's our objective to make our retail shareholders a lot of money in that process, as well for our our bigger investors, our strategic investors, as you mentioned, Silver Corp, Pan American Silver, what their final objectives are. I mean, you'd have to ask them specifically, but what I say is we put our company in the strongest position possible if we can get these projects to the point where we've completed the technical work, we've got our permits, and we can go ahead and make the decision as to whether or not we want to finance and build them ourselves, or maybe somebody else wants to come in and pay us for the privilege of acquiring and building these rare world-class tier one silver assets themselves. But as long as we've got the work and we've done our work ourselves, then we've at least got a credible alternative. Or I think what happens with a lot of juniors is they can get into this position where their number one strategy is to get bought out. And so what I've seen it happen time and time again, is that the acquiring companies, they just wait, and they just sort of wait it out, and they wait it out, and they wait it out, because they've sort of calling the company out for not necessarily having that progress internally and building that capability internally, and then the company, when it's time to sell, is in a very weak position. Versus for us, it's no matter what we do, we just got to focus on what creates the most value for our shareholders in the long run, and it puts us in the strongest strategic position, is to just sort of continue along our track with the technical work and the permitting, as you said, sort of in that Lassonde curve, which I know the Lassonde curve is typically, as a developer, is seen as a bad thing because there is this trough. But again, the trough to peak, I've seen it time and time again. I talked about the stories like the Lundin Golds of the world, and there's many more of them that I've seen before. That is a really powerful place to make money as an investor, whether you're a corporate or a retail shareholder.
Yes. I'm thinking about another point that you made previously. There's nothing to disagree with there with the last part of the Lassonde curve. What I'm thinking about is, again, this M&E and how far you have to take this project up that Lassonde curve. How much money is it going to cost, and how long is it going to take? And I want to ask you that, but that's almost too much of a question. Like, you have to have a few crystal balls. I don't think one crystal ball would do it to answer it. But I mean, try it to the best of your abilities. How much money do you have to spend, and how long is it going to take before this is buyable, basically, by a major?
Yeah, I think because we got, like as you said in the introduction, we've got 23.5 million US in cash. I think our budget for this year, I think, see us going down to, I don't know, 16 million, something like that, and then we got easily another year's worth of runway after that. So that would get us sort of to the end of 2025. And again, it's for both projects, going through the process of permitting and government engagement, and there's a high degree of inherent uncertainty in that process. And so to say that, hey, we're going to get this and this, solve for X, boom. I mean, that's fiction. Like I think where that could be and when it's going to happen, it'll happen when it happens. I think there's no doubt about it. There's a conceivable scenario where let's say, later, let's say next year or whatever, the end of the year, like we're kind of in a position with either one of our projects where they're sort of ripe and can be sort of picked off. But I think one of the nice things about having two projects is that we sort of have two horses in the race, and the interplay between those two, they're in different departments. Our silver sand projects in Potosi, our Corangus projects in Aurora. We've just, within the last several months, as we are kicking off this PEA process, we've been advancing our discussions with the the political actors in Aurora and federally, and getting some really good traction. So sort of have this competitive dynamic between the two projects as well that we think will help us. It certainly does help us internally, where it's like there's room for one at a time, and so that also helps accelerate the time horizon. But yeah, you look at our cash position. I know you're asking for a specific answer, but I'm just being honest with you. It's difficult to say at the moment, just because, again, getting everything lined up and across the line, there's a lot of stakeholders that we're working on getting aligned around development concepts at both of our projects. And again, which one of them gets to the finish line first and when that is, could it happen with our balance sheet that we've got today? Absolutely. But the pinning down an exact date and time, and does it take a little more time? Does it happen faster? Those are also equally possible scenarios.
Could it happen at the same time, where they get taken out at the same time by one buyer?
Absolutely, yes. That's something that, again, we've been asked about, and we are analyzing internally, does it make sense to split things up, right? We've got three projects. We don't really talk about Silver Strike, but still a highly prospective property. Do we split the company into different bits? Do we sell one, like the Silver Sand project, up front and use the proceeds to help advance and move Corangus forward, vice versa? How do we do it? These are all discussions that are under evaluation, but we've yet to, in conjunction with our board, really coalesce and crystallize around a preferred alternative. But these are all sort of nice problems for us to have, and really showcasing the benefit of having multiple projects within the portfolio.
But in the meantime, essentially, the focus remains on, let's push Corangus to PEA, let's push Silver Sand to PFS. Look, you're not looking to diversify away from Bolivia, get a different project, or do anything else in the meantime before PEA and PFS, respectively, for those two projects are achieved.
Yeah, our focus right now is on our projects. That being said, of course, like every company out there, there's always, if there's other opportunities that arise, again, we sort of evaluate anything that comes in and it may look interesting. But I would say that the lion's share of our attention right now is on our Silver Sand and Corangus projects, moving them through the technical phase, moving them through the permitting phase. If any other interesting scenarios do come up, of course, we've got a fiduciary obligation to evaluate them and propose whatever would make the most sense for our shareholders.
So in chronologically, again, you said PEA for Corangus Q3, PFS for, yeah, go ahead.
Silver Sand's coming faster. So we've got our Silver Sand project kind of looking, we said, middle of the year. So we've got another month until it's the middle of the year. So we're expecting to release our Silver Sand PFS momentarily, hopefully in the next several weeks to month. And then following that in probably September, Q3, we're calling it, we'll be looking to release our Corangus PEA.
And that's a good point on bringing up Silver Sand, because I'm really picking at it. I'm just looking for something to figure out. Like, I get that you have a Bolivia discount to it, but I'm just looking for reasons as to what am I missing here, because maybe the market knows more than me. Although, you're getting a very nice bump. You're almost doubled off the lows, but you're still far away from the $9 that you were in 2021. It was prior to you joining, but still, it was $9 a share. And so you're now down, 60-70% from that. And so, and I'm really picking at it now, but maybe a point to talk about is that by the looks of the cross section on Silver Sand, it looks like the deposit is somewhat patchy, and I'm being careful as to how I'm going to say it, because it is not patchy. I typically not classify this as a patchy, project, but the strip ratio in the PEA was also coming close to 4, so it's not low. It's not high too, but it's not low. Is there anything you can do during the PFS to optimize that? Is it reasonable to expect that you will? And is this really going to be a risk or something that you're thinking about?
And, these are all very fair questions. I'd say on the geology, I mean, the point that you're saying, like certain areas, like the deposit itself is thousands of very small veinlets that host economic or that host silver mineralization that coalesce together in enough density that we can open pit mine the whole thing. And your question about patchiness, so that question I think was brought forward before I joined the company, and we made a deliberate exercise to drill a certain section of the deposit on 5-meter centers, which is that's like production drilling. And we there's actually you can see the geological interpretation on, say, what was 25-meter sections, and then you fill them in on the 5-meter sections, and we got really good validation of the geological interpretation on the 25-meter sections when we drilled them down to 5 by 5-meter centers. So we had a very good degree of confidence in this area, and sort of that gave us peace of mind that our geological understanding and the resource modeling were done to a high standard. So we're not as fussed about that. I think I don't know, when you look at the just going back to the share price, let's say, I mean, we were we touched a high level, and I think that was also in a very an environment that was correctly perceiving that what we have made is a very substantial silver discovery. And perhaps as we've given some of those gains back, I mean, just part of it is maybe just like this takes time, and you look at the average length of time it takes between a discovery and first production. I think it's something like 10 years. And so we're kind of I think tracking along that line as per expectations. I just think perhaps maybe that's some of it is that natural rotation from sort of fast money speculating on exploration into, okay, like you said, you mentioned the Lassonde curve, but that sort of natural churn from one set of shareholders with a different set of objectives to another that are more focused on sort of the slow burn of building value over the long run as we go into project development. So I think there's probably a lot of that is quite natural. Obviously, that's cold comfort for those shareholders that we're in at higher levels, but we are here today and we can only look forward. So I think that would probably be my commentary towards the price action over the last few years, and looking at technical risk. I'd say that again, the geology side, as we said, you said patchiness, but we've validated that with the tight space drilling. I think it's really just taking the time to move the project forward and go through the permitting process and everything. It just takes time, and so we continue to ask for patience as we go through this process.
Are you doing anything else on the geology side, as in trying to understand? Because I assume that the continuity thing might have something to do with not a geologist, but to do something with the structural controls of the deposit. But so, are you doing anything else to try and understand that completely, or can you I mean, can you do any more geological work here?
Not really at this stage of the game. I think that's at our Silver Sand project. Like again, we've got a very good understanding of the general orientation of all those sort of thousands of silver veinlets. Yeah, the dip orientation is also fairly regular. It's just maybe the frequency of the mineralized veins. That's what really drives the gaps that you see when we drill. But I'd say that the parts where we get wonderful continuity, that's where you get these incredible drill intercepts that really excited the industry back when I was a portfolio manager, when this deposit was being drilled out. I'd say more of the geological work that we're doing is focused on our Carangas project, where and it's less so where we've discovered. It's more so the regional exploration potential. I think that's where our geologists are putting a little bit more time. We sort of call it boot leather geology, because we had a big land package at Corangus, and I didn't go through it, but the discovery story was that the main discovery was blind. It's under about 40 meters of covered by sediments in a much larger basin. So we completed a geophysical survey in the entire basin, and several anomalies lit up that are actually bigger than what we found so far. And one of those anomalies actually overlays the mineralization that we've discovered at Corangus. So that's probably where we're doing a little bit more geological work internally. Again, just trying to pick out where exactly some of our next drill targets would be, for us to prove out that what we found is part of a much larger district. But as far as more academic studies at both projects, nothing currently contemplated, as you've sort of alluded to.
I also think that the share price performance, to go back to that here for a second, has something to do with the ETFs. The GDXJ, I suppose, is what you were in, right?
Yeah, I mean, gosh, we went through I should say our shareholders, again, I'm one of them, went through a very painful period kind of earlier in the year and late last year. We got sort of collectively through 3 different indices booted out or puked out, or the reference to it, 7 million shares we calculated, which is significant. You look at we got 171 million shares outstanding, but roughly half of that is tied up in long-term sticky hands strategically, and so our free float isn't exactly you take that, divide that in half, and then 7 million shares. I mean, it was a big number, and certainly our share price suffered from it. Nice to see it bounce back more recently, as certainly in conjunction with the silver price perking up. But that's where a lot of the torque can come in, is as we continue to do good on our projects and advance things in a constructive silver market. All that stuff, all those, you come out of indices, you can come right back in too, and you can see the buying kind of work in the opposite direction, sometimes violently. So again, we got to keep reminding ourselves that yes, that happened, but all that means is that going forward, we're in a much stronger setup.
Why I'm even bringing this up, because I know it's, well, technically not exactly under your control whether you get kicked out or taken into these ETFs, but I'm trying to think about the 2 shareholders, so the Pan American Silver and the Silver Corp that you have in there, and thinking about, do they have, well, because if they want to get those deposits and turn them into mines, they would want to get them as cheaply as possible, which is the exact opposite of what I would want if I were to become a shareholder, right? So, but at the same time, they're also current shareholders right now, so you don't necessarily want to piss them off where to a point like they sell their shares in the open market or whatever other type of issues could arise from that. So how do you manage that relationship, where knowing that those 2 are, and you don't have to say it, but I suppose I could say it, and in my opinion, those are 2 suitors that would make sense for both companies, maybe one more than the other, but it would make sense for both companies. So how do you manage that relationship where you don't kill your potential relationship with your potential buyer, but at the same time you also give enough upside to your current shareholders?
Yeah. So it's a great question. And so, I mean, just look at our board of directors. We got a representative from Pan American Silver, and Martin LaForne. He's our senior VP Tech Services. And we've got a representative on our board from Silver Corp. Paul Simpson is longstanding director of Silver Corp. Joined us in September last year. So we've got that representation, and we got a lot out of it. I think, again, being able to share ideas and concepts with both those very seasoned, established silver producers. There's no question that our shareholders benefit from having access to the intellectual capital that exists with both of those companies. And I think going back to the rest of the shareholders, like myself, right, is at the end of the day, firstly, I'll point out that there's 2 of them, not one. I think the issue that you're alluding to is you have maybe one shareholder like that, then it's a much more sort of captive audience, or versus if you have 2, there's naturally some competitive tension there. And so I think that helps to a large extent neutralize some of those concerns where I think neither company would let things go without a fight. And so I think that ultimately is a dynamic that our shareholders will benefit from. But it goes back to even if both shareholders, let's say we're doing something as you suggest to collude to keep our price down, which again that's I'll tell you categorically they're not doing that. It's nonsense. But I understand the suspicion. The best thing that we can do is, like I said, focus internally on building the value and doing the technical work, advancing our permits, and that just puts us in such a strong position where, again, our board and the our independent board, myself, management, can really make that assessment, if and when that time comes, to ensure that our shareholders' interests are protected. And I'll tell you what, I'll be the first to say, not going down without a fight. So it's not going to be a situation where we just sort of roll over and all the hard work that we put into this thing will go away without a luxurious premium that really compensates us for parting ways with these phenomenal assets.
Andrew, we've been at it for a while. I just now realized, but the conversation's been going nicely, so I didn't want to cut it off. But I do realize that you almost have to go here. So what am I think I've been through most of the stuff. I have plenty of notes, and I'm kind of getting lost at this point. But what am I forgetting to ask you? Let me maybe take it from there. Yeah, what am I forgetting? What did you come here hoping to talk about that I'm not bringing up?
I think it's just you've hit on it all. It's just getting the story out. I think again, we'd never engaged before, and I think just we talked about Bolivia and how that tends to be something that Bolivia, like I don't know if I want to look at this company. I would encourage folks to look at Bolivia, and again, it's a mining country, and it's very much in a unique situation as a country where it's embracing and pivoting towards embracing in a meaningful way foreign mining and private investment as in a way that it has been sort of less inclined to do over the last little while. The country's very much in that mode right now where they need the private sector, they need foreign mining investment. And these windows can sort of open and shut in these various countries if you look at a very sort of long-term, decade, century time horizon. And it's very much our view that windows is popping open here in Bolivia, and we're sitting in this country in pole position with these two projects that will be sort of two of the best silver mines to get built anywhere in the world when ultimately we're said and done with it all. And I think the Bolivia dynamic is it's really important, and I would strongly encourage folks to do their homework, and because it's a very good situation in the country right now as a lot of the mines that were built in the last cycle are coming towards the ends of their useful lives, sort of bottom of the eighth, top of the ninth inning, and the government recognizes that, and these mines are a big engine for taxes and royalties in the countries. And I don't care what any mining promoter tells you, the mines, they don't last forever. And so we need that new wave of investment. And so I think it's a very good situation. It's just, again, sort of like anything, it takes time and patience, and we're going to continue to sort of, in a very disciplined way, continue to move these projects forward. I think that's maybe the Bolivia aspect would be, and something that just make sure that you and your listeners are aware of that. Again, these jurisdictions, they open and close, and we very much feel like there's a nice window opening for us.
I appreciate that overview, Andrew, and I'll be following along, and hopefully you can keep giving me updates on it. But I really do appreciate the overview, and I'm sure I'm forgetting a bunch of stuff to ask you. There's just so many things happening at the companies. Well, we didn't talk about your other project that is an exploration project that I suppose is eventually going to come into the story as well. But maybe that's something for our next conversation. And again, if people are listening, whatever I've missed, please put it in the comments. I do miss a lot of things, so I can ask them next time. But yeah, Andrew, thank you so much for investing your time with me. This was a pleasure.
Thanks so much, Antonio. It's really nice chatting with you.